This is going to be, as we all know, a really interesting week for tech.
It's more about tech than it ever has been.
Investors are starting to demand a little bit more.
Anytime you have a technology shift, you're going to have big winners and big losers.
The big question is, can we still see the degree of margin expansion out of the tech names?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, ramping up spending. Mega cap tech showing no signs of easing up on a major spending spree. Fed Chair Jay Powell heading towards the exit, hitting pause on rate cuts, and gold continuing its explosive move higher on a 9-day record-breaking rally. Gold topping 5,500 for the first time ever.
This rally is 28% so far in 2026. We are not yet done with the first month of this year. Trading is getting thinner. A lot of banks are having difficulty taking more risk. There is a question why. Is this because of the investment in the physical world? Is this because of concerns about Fed independence, despite what Fed Chair Jay Powell is talking about? Is this a Sell America trade, or is this a trade that has taken on a life of its own as people go to Costco and buy gold bars?
It's not just gold. Gold up by close to 30%, silver up by more than 60%, copper up by 12% already year to date.
And a lot of this has to do with not just the precious metals and the idea of the debasement trade and wanting to store value. When you think of metals like copper and silver, you can actually use in the physical world. As you see the capex spending coming from places like Meta and Microsoft and what's going on with the AI trade, you can understand why commodities are moving higher.
Big move in the equity market as well. 6 days of gains on the Nasdaq 100. More gains ahead for us. S&P 500 futures up by 0.1%. These two names in focus, Meta and Microsoft, major spending plans. But if you don't put up the growth, you'll be punished. And that's the difference between the performance of those two names in a pre-market.
Yeah, this is, to me, the key question. What was it about the tenor of the way that they described some of the spending that caused such polar opposite responses in markets? Meta said it was going to spend up to $135 billion this year. That is up more than 85% from the same time last year with some $71 billion. And people are rewarding them because guess what? They're showing that they are actually reaping benefits in some of their ads, in some of the spending that advertisers are giving them. At the same time, Microsoft, a big question about a lack of capacity to really meet demand. And that, I think, continues to be the ongoing concern.
They're both spending a ton, but it's where they're spending. And for Microsoft, the fact of the matter is that growth is not in Azure the same way investors wanted to see. When it comes to Meta, the spend is outrageous, but where it's going, investors liked.
Should we get to the Fed?
Please.
These were the headlines after the close. It was big tech. The Fed. Here's the recap from RBC. No comment. Literally, that's the headline. Yeah. HSBC, some dissent, but no change in direction. Citi's Andrew Hoddenhorst, Chair Powell did his best to give no new guidance.
So I actually did a bunch of searches about how often he said something like, Chair Powell said something like, I don't have anything for you on that today. I don't really have any response to that. I'll refer you to my statement. I won't give you anything additional to that. Pretty much most of the answers that people want, most of the questions that people want answers to. Are you going to stay on the Federal Reserve? What's your view about the independence of the Fed? How about that subpoena that is a requirement to resolve before we can get any additional members of the Fed confirmed by Congress? All of these questions, I don't have anything for you for that today. So right now we're looking at the economic backdrop, and that right now remains in a pretty even place.
Journalists did their best to make it interesting, and ultimately Chair Powell was determined to make it boring, and he won. Equity futures right now in the S&P just about unchanged. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research as big tech lifts stocks to record highs. Angelo Zeno of CFRA with Mag 7 earnings in full swing, plus Claudia Sam of New Century Advisors as Fed Chair Jay Powell sticks to script. We begin this hour with stocks building on record highs and the dollar sliding. Ed Yardeni of Yardeni Research writing a weak dollar boosts the gains for US investors in overseas financial markets. It certainly supports our recommendation to overweight emerging market stocks. Ed joins us now for more. Ed, good morning.
Good morning.
Hey, it's good to see you. Is this a repeat of Q1 last year, the performance of the dollar and the performance in international equities?
Well, there's a bit of deja vu all over again, but in the first quarter of last year, we had DeepSeek hit the Magnificent Seven right from the get-go, and so that was actually a sell-off. This time around, the Magnificent Seven seem to be kind of mixed, but on balance, they seem to be holding their own quite well.
And the Nasdaq has started to outperform more recently.
Yeah.
After the outperformance we saw previously in small caps so far year to date, that started to fade.
It's kind of a bull market in everything, and so if something lags, it gets a chance to catch up.
How would you describe this regime that we're in right now? We've heard a lot of different things being thrown around, debasement trade, sell America, but to your point, I'm just seeing record highs all over the place in metals, in equities,
it's just
worldwide.
a worldwide bull market. And I think that's because central banks across the board have provided an enormous amount of liquidity. We actually have some liquidity probably left over from the pandemic. I mean, there's over $7 trillion of money market mutual funds. So, if the Fed were to actually lower rates, that would probably continue to fuel this bull market. But it doesn't look like it needs any fuel from the Fed because earnings have been phenomenal.
Just if you develop that a little bit further, and this sort of builds on something that John's been talking about over the past couple of days, how much is the sell-off in the dollar a response to this sort of global bull market? And how much is it a response to debasement based on concerns about Fed credibility and based on policy uncertainty?
I don't really get all that excited about these general terms like debasement because there's only, like a year and a half ago that The Economist was running cover stories about the exceptionalism of America, and then all of a sudden we're not exceptional anymore. I think there's still a lot of things that are exceptional about the U.S., but including the resilience of the U.S. economy in the face of all the shocks. But you know what? The global economy has held in there remarkably well also. And I think we are seeing people kind of take note that emerging markets continue to emerge. As a matter of fact, a global index shows that more manufacturing production now happens in emerging economies than in developed economies, and more exports. And so we aren't really it's not debasement, it's not deglobalization. It's kind of rebalancing of portfolios. So as the stock market goes up, people actually get more nervous that they've never made so much money and maybe it's going to take a dive. So they buy more gold because gold and stocks tend to be inversely correlated. But on a trend basis, they tend to go in the same direction.
It's rebalancing on a lot of different levels. It's
Correct.
rebalancing when it comes to the U.S. versus the rest of the world. It's also rebalancing with the financialization of U.S. markets and global markets going into the physical world. Right? We're seeing the actual capex continue to expand. Does it seem plausible that we can continue to see this expansion in capex without inflation, especially given some of the inputs from precious metals and actual base metals?
I hate to tout my own brand here, but I've been talking about the roaring 2020s since August of 2020, and baby, it feels like it, I mean, come on, let's have fun here. And the reality is it's not all speculation. It's productivity, and productivity is really what's driving all this.
We're halfway through your end decade target for gold.
Right.
Do you think we actually get there quicker, the 10K mark? And do you need to start rethinking about where you're pricing precious metal?
I'm running to catch up. I mean, when I've never had an opinion on gold. I mean, I'm a strategist. I need something to value. So, however, when it crossed above 2,000 back in 2024, I said, you know what? It's really pretty simple. A lot of foreign central bankers have decided to buy gold after Russia invaded Ukraine, and we froze Russia's assets. So gold has been absolutely on fire since then. So when it got to 3,000 at the beginning of last year, I said, let's look at the charts. Probably 4,000 by the end of the year, got to 4,500, and I raised my target for this year from 5,000 to 6,000, and we're going to be at 6,000 by the end of the year or next week.
It feels speculative, though, at this moment. It feels almost like it's trading like a meme stock. Why is that?
Well, I think on a global basis, Bitcoin and gold have a lot in common. It's hard to value them. It could be zero, it could be a million, whatever you want it to be. But in the case of gold, I think it's in both cases, it's a global market. People are buying it 24/7. And so I think there's a lot of geopolitical uncertainty. I mean, we've got an armada off the coast of Iran. We've still got issues in Venezuela. Meanwhile, there's been a purge of generals in China, and we don't know what that entails. And so if there's and the president has brought back the Monroe Doctrine with a Trump corollary. Well, how about the Putin Doctrine? How about the Z Doctrine? So I think there's a lot of geopolitical risk.
Given everything you describe, it's pretty impressive. 10s are still at 425, isn't it, in the Treasury market?
It's been amazing. I'm kind of wondering where the bond vigilantes are. Oh, I know where they are. They're in Japan.
They showed up last week, didn't they?
Yeah, but you know what? I think they're kind of getting frustrated because they can't bring it down. They can't cause a crisis. Japan may be impervious to a bond vigilante attack, so maybe they'll come back here. But look, I think it goes back to the dollar. This is still a safe haven. So, as soon as people get scared again about geopolitics, I think you'll see the dollar come back. And the administration, first the president says, great, the dollar's going down. And then Scott Bessent, his Treasury Secretary, says, we like a strong dollar.
I just want to get to that point. You still believe the dollar is the haven?
Absolutely. Absolutely. Look, people have been saying, oh, the dollar's going down, foreigners are bailing out. And then the Treasury has monthly data through November showing that actually, over the past 12 months through November, foreigners bought a record $700 billion of U.S. equities and a near record of almost $1 trillion of fixed income securities. So the data just doesn't add up with the myth that everybody's bailing out of the dollar.
Ed Yardeni of Yardeni Research is going to stick with us. I'm right there with you, Ed. Some of these narratives at the moment, overly simplistic, I think, and failing to stand up to basic scrutiny when you look at the basic data.
There seems to be an incredible tension right now between the sentiment that people have towards some of these policies and some of the rhetoric coming out of the administration versus the tech boom, the energy and the consumer, and the growth that you're seeing in the United States that leaves it as a place so many investors feel like they need to be exposed to.
Stocks very close to all-time highs on the S&P 500. Futures up by about 1/10%. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. We're seeing Microsoft's shares falling 6.6% in the pre-market. The company saying spending hit a record while cloud growth slowed, fueling concerns over the payoff from its AI investments. CapEx in the fiscal second quarter hit almost $38 billion, up 66% from a year ago. On the flip side, Meta shares are surging 8% in the pre-market. The Facebook owner reporting fourth quarter revenue that topped analyst estimates and gave a strong forecast for the current period. The company projecting record spending in 2026, driven by CEO Mark Zuckerberg's aggressive campaign to amass AI infrastructure, computing power, and talent. And the Fed holding rates steady, marking the first pause in its cutting cycle since July. The decision was approved in a 10-2 vote, with Governors Christopher Waller and Stephen Miron dissenting in favor of a 25 basis point cut. Waller's dissent in favor of a rate cut is seen as keeping him in the race to replace Powell as chair of the Fed. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. More from Yahara later this hour in about 30 minutes' time. Up next on the program, dollar whiplash.
If we lost the world standard dollar, that would be like losing a war, a major world war.
Dollar's doing great. I could have it go up or go down like a yo-yo.
And that's exactly what it has done in the last 48 hours. Up next, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Later this morning, 8:30 Eastern Time, jobless claims. Then, in the mix after the closing bell, a big earnings report after the bell. After the market close, we'll hear from Apple. Apple earnings a little bit later. Equity futures doing okay on the S&P 500. Positive so far this morning on the S&P by 1/10%, on the Nasdaq up by 0.15. In the FX market, the volatility of the last few days. Euro-dollar proving over the past few days that life above 120 is difficult at the moment. 119.48. Just think about the last two sessions we've had for the euro. The worst day since August and the best day since August, back to back over the past two sessions.
Yeah, and on what, right? Here's the question. Is it because some incredible data came out? No. Is it because of something substantial that happened in earnings? Nope. It has to do with comments coming out of the president about being okay with a weaker dollar, and this real question of why the knee-jerk reaction was so extreme, right? At a certain point, especially if Scott Bessent's going to come back and do his thing, we still have a strong dollar policy, why was there this whiplash in markets?
Euro-dollar 119.48. Under surveillance this morning, dollar whiplash.
If we lost the world standard dollar, that would be like losing a war, a major world war. We would not be the same country any longer.
It's hard to explain to people. The headline we go, oh, Trump wants a weak dollar. Not a weak dollar. Dollar's doing great. I could have it go up or go down like a yo-yo.
So here's the latest this morning. The dollar trading near 4-year lows despite Treasury Secretary Scott Bessent's efforts to ease concerns about the greenback. With the latest, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John, good morning. Well, as you just mentioned, we heard from the U.S. Treasury Secretary Scott Bessent yesterday, where he maintained that the U.S. always has a strong dollar policy. He added that the administration's broader agenda would help make the U.S. the, quote, best place to come, in his words, and said that efforts by the administration to bring down the deficit would contribute to the dollar's strength over time. The thing is, our own analysts at Bloomberg assess that the Treasury Secretary's more measured response is unlikely to alter the dollar's bearish trajectory. And while we have heard competing views from President Trump, as you just played out there, our analysts also point to the fact that he has long maintained that a weaker currency could help drive U.S. exports and bolster those very industries that he has been really focused on, particularly domestic manufacturing. Plus, we know that a lot of issues are weighing on the currency, driven in part by the unpredictable policymaking here in Washington. Perhaps most notably, we know tariffs have been a big driver of the currency's weakness, and we've just seen in the past month a whole new slew of threats out of this White House, from allies like South Korea to even our NATO partners. Plus, I'll just throw in the fact that it is still unknown if we will avert a partial government shutdown this weekend if lawmakers are unable to reach a deal when it comes to funding by Friday at midnight. Though John knew overnight, a person familiar does tell us here at Bloomberg News that Democrats and the White House are inching closer to a deal, but at this point, it's just too soon to tell.
Tyler Kendall with the latest down in Washington. Tyler, thank you. The Treasury Secretary engaging in the conversation, the President engaging in the conversation, Chairman Powell having absolutely nothing to do with it in the news conference yesterday.
We don't control the currency. That's not our business. That's the Treasury. Don't look at us. I was actually a little frustrated that there wasn't a follow-up question. Well, if you do get a weaker dollar, does that import more inflation in a way that could potentially be something that you would have to address? At what point would you actually have to entertain this as something that you do take up, because it does have an economic factor? But, no comment, and he got away with it.
That's the playbook when you interview anyone at the ECB. The ECB is engaging in the conversation for that very reason. Ed Yardeni's with us now of Yardeni Research. Ed, let's continue that conversation. Does it have consequences for the outlook for price stability?
Absolutely. I mean, a weaker dollar does tend to be inflationary. And if the administration or if the president is basically saying on balance, I mean, you have to kind of average all of his comments. But on balance, I think he does want a weaker dollar because he wants more manufacturing in the United States. So that's already having an impact on commodity prices. Commodity prices obviously are a leading indicator of inflation. So if you ask the commodity markets, not me, what the outlook for inflation is, it's coming back.
Financial conditions are easing.
Very easy.
The administration is going to boost potentially more fiscal stimulus. We're going to see that in tax refunds maybe in the next couple of months. And then you've got the dollar story on top of that. And everyone's talking up a better growth profile. Yet, still not in the consensus is this idea that inflation is going to pick up, and I'm surprised by that.
Well, there's a lot of moving parts here. I think that actually inflation is going to go down. Doesn't mean that I'm going to be right. It doesn't mean that isn't going to be a concern in the market about inflation coming back. But I'm a big believer in productivity. I think the productivity story was awesome last year, and I think it's going to continue to be surprisingly strong. And productivity is like fairy dust. Everything's better growth, lower inflation, better real wages, and better profit margin.
Ed, to Jonathan's point, though, we are going to have a lot of fiscal policies coming out of
Stimulus,
Washington. Not just the tax refunds, but this is an election year. The administration's going to run it
Correct.
hot. So why do you think inflation is actually going to come down?
Well, there are inflationary forces like the weak dollar and the fiscal stimulus that you mentioned. The fiscal stimulus obviously is one of the reasons why the economy is so strong. In addition, the consumers held in there because the baby boomers are retiring and spending a lot of money. So the demand side of the economy looks great, and it's going to be even stronger with the fiscal stimulus. And that could be inflationary, certainly. But if you continue to have a relatively quiet employment market, then the implication is that productivity is extremely strong. So I would just say with all the factors, all the moving parts here, and the yo-yo of arguing inflation is going to go up or it's going to go down. I'm in the camp that thinks that inflation is going to be surprisingly low this year because productivity is going to continue to be surprisingly strong.
Tyler mentioned the fact that the president just this week was talking about increase in tariffs on South Korea. Do you think the market has just completely blown past that story and it's no longer of interest almost?
Yeah, the market has its own resilience. You know, I've been doing this for a while, and what I've learned over the years is that the markets, the stock market and the U.S. economy have done remarkably well despite Washington. And in the current situation, I think you have to keep your eye on the prize. And the prize is productivity is creating tremendous resilience for the U.S. economy, which in turn is creating remarkable resilience for earnings. And earnings are at a record high and going higher.
The headline for my dinner tonight with my children is productivity is like fairy dust. And then I'll say discuss. I mean, to me, I guess that the ultimate question is for who? And you just led to it, which is earnings. It's not necessarily for people who might be losing their jobs. And we've seen announcements from Home Depot cutting 800 corporate jobs, Amazon cutting 16,000 corporate jobs. This has to do with how people feel, sentiment. It has to do with politics. I mean, how does that factor in to how this goes?
I think this is one of those kind of historic transition environments that's resulting from the technological revolution, digital revolution. And there are certainly people that are losing their jobs because of the improvements we're seeing in technology, and that's obviously hurting. But you know, it takes a couple of years, but I think we're going to be amazed at how resilient American workers are, and they're going to reinvent themselves. One of the things that's just astounding to me is that we had over 5 million business applications, new business applications last year, all-time record high. So I think a lot of people are saying, you know what, I'm not going to try to get a job in a company. I'm going to start my own business.
Right now, looking at this backdrop, why would anyone want to invest in debt over equity? Because it is a growth picture that is being juiced on all fronts for the equity picture.
Right.
And on the debt picture, they're only going to incur more debt to try to ameliorate some of the concerns in the average population that do not feel these gains, the fairy dust.
Well, it's really, it goes to our previous conversation about rebalancing. As the stock market goes higher and higher, as gold goes higher and higher, people are enjoying the gains. But on the other hand, they get a little bit queasy about, getting too close to the sun, like Icarus. His wings kind of melted off. So they tend to start to rebalance. And so they will rebalance. I mean, why are we have a record amount of money in money market mutual funds? A lot of people are missing a great rally in gold and in stocks. Well, maybe not. Maybe they are enjoying those rallies, but they also say, you know what, I got to have some liquidity here just in case things don't go well.
Bridgewater, by the way, agrees with you. Stocks over bonds.
I think a lot of people agree with us. We've been talking about that for a while, and people are saying in this pro-growth environment, why would you want to own the thing that people are only going to issue more of and then it's getting less valuable? And that ultimately seems to be a bet that's playing out.
Yeah.
AI is covering a lot of cracks. Let's put it that way. Annmarie talked about the threat of tariffs on South Korea. The Kospi this week is up by almost 5%, and it's up by 24% year to date.
Thank you, Samsung.
Massive movement.
Massive, yeah.
One other name in the mix as well. Just feels like that's the story of the moment. My big takeaway from the Fed program yesterday was Diane Swonk, KPMG. She's talking up an economic boom that could come with a payrolls recession. Just think about that. How do you set policy for that? An economic boom with a payrolls recession.
I mean, the initial claims data looks great. I mean, initial claims have been coming down. So layoffs are actually going down. Maybe the Amazon news is going to affect it in the week ahead. But Amazon, I think, is talking about global employment. It's not like all those 16,000 jobs are necessarily going to be lost right here in the United States. So I think that I think the payroll situation is going to be surprising to the upside.
I hope you're right. Ed Yardeni of Yardeni Research. This is a week where we're talking up growth north of 4%, maybe 5%, and yet consumer confidence is rock bottom. It has never been lower in the last decade.
And this has to do with the fact that people are not feeling it yet. And they're seeing the layoffs, they're seeing the inflationary impacts, the year over year, the 5-year over 5-year impacts, and it's weighing on them. How do you set policy? You asked this question, no comment. I don't have anything for you on that. Not going to really go there. Look at my statement from last month.
I know there's an industry in criticising the Federal Reserve, but given the president's comments, the chairman's comments a few weekends ago, he took on the White House in a way we've never seen before in the modern history of the Federal Reserve, and wasn't prepared to answer some basic questions about why. And I think we need to follow up on that.
I think he will continue to ask that question. Let's see when he has a follow-up.
Up next on the program, we'll catch up with Angelo Zeno of CFRA as Meta and Microsoft ramp up AI spending. Snapping a streak of 5 days without losses on the S&P 500 yesterday with the smallest of losses in yesterday's session. Futures bounced back by 0.1%. The rally continues on the Nasdaq. 6 consecutive days of gains on the Nasdaq 100, the longest winning streak going back to September. For the year so far, some outperformance for the Russell. The small caps, that outperformance beginning to fade over the past few sessions. Let's keep an eye on that. This morning, some outperformance on the day, up 1/3%. Let's turn to the bond market. Bit of a snooze in the bond market right now. 2s, 10s, 30s, 10s at the upper end of the range for the year so far. 4.2512 and 2s anchored around Fed policy. That Fed is going nowhere anytime soon. 356.93 on 2s. And in precious metals, this move right here, gold, absolutely flying year to date. Gold up another 2%.
Honestly, it just raises this question of how vulnerable is this trade? And I know I'm sort of going against the grain here, but at a certain point, liquidity starts getting really thin. And then if two people over in Asia buy gold, suddenly that kicks up the price significantly. So you start to wonder how sustainable this is if institutions are pulling back to some degree from some of the daily trade.
What's hilarious is these year-end price targets we've already gone through. Goldman, just at the start of the week, changed their year-end target to 5,400. Now we're past that. So I think they need to recalibrate where they see this precious metal going.
So you've all heard that story about the debasement trade, Sell America, all of that stuff. We talked about this over the past few days. This is also pretty consistent with a pickup in global risk appetite. You see that in copper, trading close to record highs. You see that in the Kospi with an AI twist. South Korean equities, record highs up by more than 20% year to date. You see it in foreign exchange, the Aussie outperforming a G10 over the past 12 months. Caterpillar just dropping earnings. EPS coming in at 516, the estimate 469. Revenue for the fourth quarter in at $19.13 billion, the estimate 17.91. That is an upside surprise.
And you're seeing the shares jump some 5% in response to that. Their machine power and energy revenue also coming in almost 20% year over year. When you start talking about this, the physical world is having its revenge. And what you're seeing is people right-sizing their understandings of how much more equities have to rise to match that. In bond markets, they've been punched across the face with so many different headlines that they're just in a stupor of malaise. I mean, honestly, the MOVE index is going nowhere. So the excitement is really in equities. The excitement is in the real world. It's not necessarily in the debt profile.
We have some problems in the real world. There is no doubt about that, but it's being insulated by some massive spending taking place at the moment. Caterpillar is up by more than 5% of the pre-market. As we count you down to the opening bell, let's get you some more single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Well, we have some clear winners and losers in the tech trade this morning. And we start with Meta, the clear winner, up 8% in the pre-market as it gets a pass to ramp up spending, wrap up CapEx, up to $135 billion worth this year because the payoff is already starting to show up. On the call, executives were pointing out how ad targeting is getting stronger. Meanwhile, Microsoft not getting the same pass. Shares are down nearly 7% in the pre-market because it's facing scrutiny for its record CapEx since Azure did slow. It did slow from the prior quarter. Meanwhile, that CapEx spending spree isn't just affecting tech stocks. It's also causing a metals boom. We are seeing shares of Freeport-McMoRan up 4.6% and Southern Copper up 4%. And moving on to SAP, the German company, those shares are plummeting down nearly 15% after missing expectations on its cloud backlog. And the timing really matters here since software stocks have been struggling as investors worry that AI is upending their business model. John?
Yahira, thank you. Thanks for the update. More from Yahira in just a moment. On our radar this morning, talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg the Trump administration is moving closer to Democrats' demands over homeland security funding. Elsewhere, Nvidia, Microsoft, Amazon reportedly discussing plans to pour billions into OpenAI. According to the information, these investments are part of a massive funding round which could value the ChatGPT maker at over $750 billion. And finally, Tesla discontinuing its Model S and Model X EVs, clearing factory space to build humanoid robots. This coming as part of a $20 billion AI push that includes a $2 billion investment in Elon Musk's XAI startup.
This, to me, is actually really important. This marks, as one analyst was saying, the transformation of Tesla from an EV maker into a robotaxi, robot, and electronics company. And I think that's really important, along with their announcement that they're looking to build a factory. They need to create more of some of these chips to really go into a lot of their different products. Look, this is the future. He's talked about this. People are not talking about the fact they actually beat expectations. This isn't to try to mask some sort of underlying weaker performance than expected. This is sort of the hopes and dreams of the next phase after the EV industry has faced a lot of issues and a lot of competitive.
And when it comes to the chip making, he wants to do it here in the United States. You talk about the physical world. That is the build out. Everyone is pretty much why you see these valuations so high and everyone pouring into the stock market. It's the physical build out all these companies are talking about. Steve Mann, an analyst on this, was talking about everything they've almost wanted and have heard about for years from Tesla. They're finally seeing it on paper, and they're finally seeing it come to fruition. So for Elon Musk, when it comes to robots, autonomous, they actually see the next chapter beginning, when for a while it was very much, maybe next summer, it's now real.
Do you think they can find a partner in the White House?
Yes, I think so. I think they can. I think that they're not bromance anymore, but I wouldn't say they're enemies. I think they've hatched things up.
Tesla right now up by about 2.8% of the pre-market. Let's stick with tech. Meta, Microsoft reaffirming commitments to record AI spending. Wall Street rewarding one tech giant, punishing the other. Angelo Zeno of CFRA has a buy rating on Meta and a strong buy on Microsoft. Angelo joins us right now for more. Angelo, a lot of spending, two very, very different looking price moves in the pre-market. What explains the difference between Meta and Microsoft?
Yeah, John. So I would say, first off, we're not surprised by the higher than expected spending from these companies. I think most anticipated that going into the print here. I'd say Meta's spending definitely even more than we anticipated. But that being said, at this point in time, you're looking at a guidance of essentially 30% top line growth here for Q1, and that really is what explains it, right? This is a case where it seems like Wall Street is willing to bid your stock higher if you're showing the top line growth. And it's really phenomenal in terms of the type of growth you are seeing at Meta at this point in time, and really kind of demonstrates the fact that, hey, listen, maybe all these investments that Zuckerberg has made here over the last year is starting to pay off. I think Zuckerberg in many respects is treating his company like a startup, pumping a ton of money into it. You're looking at capital intensity ratio now close to about 45 to 50% in 2026. So we've got some enormous spend going on here. We'll see what the products look like as they trickle through 2026. But as we kind of look at the performance here, at least for today, the street likes what they say.
A $1.6 trillion startup. It's not bad, is it, Angelo? Yeah. I want to talk about Microsoft. Sometimes sentiment is just shaken, and there's a dark cloud that hangs over a stock and an ecosystem. Software names at the moment, Angelo, to Yahira's point, are struggling. What's behind it?
Yeah, I mean, and when you look at Microsoft, right, they are the king of the enterprise king of software in many respects. But whether it be ServiceNow that reported last night, and SAP, and others that are probably going to report this earnings season, and just the numbers we've seen over the last couple of weeks, there's just the dark cloud over the SaaS space. And as far as what we've seen from Microsoft posting the December quarter results, the March quarter guide, it was very solid in nature. And if there's a company that could navigate some of the uncertainties that are out there, and where the enterprise space should continue to buy their offerings, it should be on Microsoft's side of things, right? So we do think that Microsoft is well positioned to navigate some of the uncertainties, the low visibility across the SaaS space here over the next couple of years. But nonetheless, that's just the narrative that's going on right now. And there are other negatives, I think, from the print here in the December quarter, whether it be the higher OpenAI concentration risk, whether it be the lower expected cloud gross margin guide for the March quarter. I think some of that also seeping into the negative reaction you're seeing from Microsoft.
Angela, let's dig into both of those things. This question around just the cloud computing growth and the pace that seemed to miss some of the more lofty estimates, and the dependence on OpenAI. There was one stat for the first time Microsoft disclosed that 45% of a $625 billion book of future cloud contracts was from OpenAI. How much of a concern is this to you, this concentration risk in the likes of Microsoft?
Yeah, I mean, I think it's something you've got to be mindful of. But, in the same respect, their non-OpenAI RPO is still growing at a fairly healthy clip. I think at about 28% or so in the quarter. It's going to be lumpy here over the next couple of years. I do think that 45% figure, while large in nature, likely comes down here over the next couple of years. So, yeah, I mean, on the surface, it's concerning. I don't think it's as concerning as, a Oracle type of situation. Clearly the fact that, the Microsoft, if they don't get it from OpenAI here over the next couple of years, should see it from other enterprise-related vendors. But nonetheless, yes, I mean, on the surface here, the narrative, again, is one where the street is very concerned about OpenAI at this point in time. I do think that funding round will probably help the narrative in terms of the cohort of names tied to OpenAI, like a Microsoft. So again, we have to wait and see.
With respect to the Azure side of things and the cloud computing, how much is this an issue that Microsoft just can't meet the incredible demand as quickly as some people would have hoped? And how much is this truly competition from Alphabet or from the likes of Amazon that both report next week?
I personally think it's more the supply constraints. I mean, they did highlight the fact that, hey, listen, they could have grown their numbers north of 40% if they had the supply. So, so I do think it is more supply constrained in nature. But, in the same respects, this is a company that's going to see also much more difficult comparisons on the Azure side of things over the next couple of quarters. 2 quarters from now, you're going to have to lap numbers like 39% year-over-year growth. So I would expect the numbers to potentially even decelerate further. Let's call it into the mid-30s range as we kind of progress through the year. But nonetheless, I mean, these are still pretty phenomenal type of growth numbers from Azure. And in fact, they actually ended up beating our expectations.
Just taking a step back, what caught my eye overnight was Jensen Huang talking about how we don't have the energy. Potentially, there's going to be constraints in Taiwan when it comes to chip making into the United States and into Europe. Are these CapEx numbers so big that actually the energy demand, the physicality of building it out doesn't actually work yet?
I mean, well, we've got to see. I mean, at this point in time, energy bottlenecks are clearly a risk out there. I mean, I'd say personally, at this point in time, the street is probably more concerned about some of the memory bottlenecks. And to be honest, I mean, when you start thinking about the higher planned CapEx spend, it probably takes into account some of the higher boost in memory prices as well. But as far as the energy bottlenecks are concerned, it's going to get lumpy in nature here. There are going to be more challenges and uncertainties. I think that's going to be more of a 2022, second half of 2027 event and thereafter. But nonetheless, definitely something to be mindful of.
Just as a market analyst and a market participant, Angela, you've witnessed markets for a long time. If we can get away from these names just for a moment, I think Lisa's doing a great job this morning of talking about the constraints in the physical world. Do you think that's the trade so far of the year, that people are just chasing that story, cross-asset?
I mean, it seems to be. I definitely think there's definitely something to be said about that. You kind of look at really where the narrative is across the tech ecosystem, right? It continues to be a pile up in a number of these chip-related type of names that would benefit from that physical AI world, as well as hardware-related names as well. So it may not be as exposed to some of the constraints tied to memory. But nonetheless, I mean, you kind of look at the play here, at least across the tech ecosystem, and it would support that thesis here. And I don't know if it lets up here. In the near term, you'll definitely get some choppiness. But over the next 3 to 5 years, when you start thinking about the shift toward an AI world, it is going to be dictated more on the physical AI opportunities, where there's also greater uncertainties tied to this SaaS-oriented trade, and we've kind of seen this accelerated shift away from SaaS to kind of the more chip-making related names here, even over the last couple of weeks.
Angela, good to see you. Angela Zena there of CFRA. Caterpillar a little bit earlier on this morning. Great numbers about 15 minutes ago. Copper on my commodity screen on the terminal right now. Copper up by 6%. These moves are just popping up all over the place.
And it just shows that the race to achieve enough capacity to really meet demand is the main constraint for so many of these. Apple, after the bell today, how much is the focus going to be on how much more they're having to pay for some of the chips that go into their smartphones and how that's eating into margins as they try to keep prices within a range? It is the physical world that keeps coming back and biting a lot of different companies.
That's the next big earnings report after the closing bell. Elsewhere, let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. UK Prime Minister Keir Starmer calling for a more sophisticated relationship after a meeting with China's President Xi Jinping. Starmer's visit to Beijing marks the first of its kind in 8 years. Xi adding China will consider giving UK citizens visa-free entry in a sign of thawing relationships between the two countries. Starmer is scheduled to travel to Tokyo before returning to the UK. Meanwhile, Deutsche Bank reporting a record profit for the year with higher trading income and a new share buyback. The results, though, are being overshadowed by a raid on the bank's headquarters. It's part of a money laundering probe looking at past dealings by staff with firms linked to Roman Abramowicz. Deutsche Bank says it is cooperating fully with the investigation. And you mentioned this, Caterpillar shares are up 3.8% after delivering an earnings beat for the fourth quarter. The construction manufacturer reporting a revenue beat with more than $19 billion. That's an 18% year-over-year increase. The company's CEO saying, quotes, "These results demonstrate the strength of our end markets and our disciplined execution." That's your Bloomberg Brief. John.
Yahara, thank you. Thank you very much. Up next, risk coming into balance.
In the labor market, indicators suggest that conditions may be stabilizing. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. We'll find our way forward as the data evolve.
That conversation up next with Claudia Sam of New Century Advisors, live from New York City. You're watching Bloomberg TV. Two mega-cap tech names to look at in the pre-market, Meta and Microsoft, both putting up massive spending numbers, but one impressing more with actual growth relative to expectations. Guess which one? Meta up by 8%, Microsoft down by more than 7%. If you push this into the equity market at the index level, equity futures doing okay, up by 0.2%. The Nasdaq just about positive, up by 0.16%. That was the headline yesterday. It was after the closing bell. It was not the Federal Reserve. Under surveillance this morning, risk coming into balance.
In the labor market, indicators suggest that conditions may be stabilizing. I think that the upside risks to inflation and the downside risks have probably both diminished a bit. It's about how you weigh the risks to the two goals and how big those and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
So here's the latest this morning. The Federal Reserve hitting pause on rate cuts for the first time since July, pointing to a steadying labour market and improving economy. Claudia Sam of New Century Advisors writing, there are reasons to be cautiously optimistic about the labour market. Reduced rates, fiscal support and solid consumer spending. Claudia joins us now for more. Claudia, it was the least anticipated Fed meeting in quite a while. In that regard, Chairman Powell did not disappoint. It was an absolute snoozer. Claudia, they seem to have this confidence in the outlook, a better outlook. How much weight should they put on recent data?
Right. Well, I think there was cautious optimism, right? There was a path forward where there's stabilization in the labor market that had been what had motivated the cuts before, concerns about the labor market. So there are some signs, didn't want to overplay it, but some signs. And Powell did sketch out a path for inflation to start turning back down. But there wasn't full conviction. Right. There wasn't, enough conviction in that outlook to actually see cuts. They're still going to want to wait and see the data. But Powell is painting the picture of further progress on inflation, further potential cuts in rates, just not yet.
Claudia, there was an element of that meme where there's someone sitting in a room saying everything is fine and there's burning all around them. This question of all the questions that he wouldn't answer going forward. I mean, can a Fed give forward guidance if there isn't a sense of who is going to be the next Fed chair and what some of the response are to some of these pretty significant questions that were asked about Fed independence, about the dollar, about a lot of other issues that were, I have no comment, I've got nothing for you for that.
Right. So in terms of the questions about, the investigation from the Department of Justice, the Supreme Court hearing on Lisa Cook, those are questions the Fed will be answering. So I think we should remember the press conference is really a window into the 2 days of deliberations about the monetary policy decision. He really needed to keep it to the economics because that's what they talked about for 2 days. Soon, Powell will be going to Congress for his semi-annual Humphrey Hawkins hearings, and that is absolutely the appropriate place to be answering these questions about politics. Powell even gave a hint to it in very Fed speak where he said, Congress is the window to democratic accountability for the Fed. That's where the Fed goes and has to answer those tough questions. So we're going to hear more on that. It's just trying to get the timing right and the forum right. Yesterday was really for him to speak for the committee on these deliberations, and I think he did a good job on that. But, the politics are there, and they're going to have to address this more fully.
There was another issue, another aspect of this press conference, and frankly, the decision more importantly, and that is one of the dissents. There were two dissents. One of them was Chris Waller, the Fed governor who is in contention to be the next Fed chair. Did you see this as a more political type of dissent, or one that actually did come with consistency in terms of some of the rationale in previous decisions?
So I expect that we'll hear from Governor Waller for his thinking on his dissent, but it does fit a pattern. Waller was early to sound alarms about the labor market. He may be late to saying all's clear or signs are clear. I think it would be very consistent for him to still have concerns about, how much stabilization really is there in the labor market, and concerns on that front. And also this piece about the inflation outlook. I mean, Waller is a forecaster to the core. He may have more conviction that those tariffs, we've seen the tariff rates that are there. We're going to have a textbook case of them rolling off. And he feels like it's worth going ahead and pulling some more restriction out of the economy. So I think there's a clear economic case that is consistent with not just Waller of the past year when he's been in potential running for Fed chair, but really Waller over his whole career. So I would really be hesitant to jump to the politics in this moment.
This is consistent, but to the same time, he is in the running to be a Fed chair, and we immediately saw his chances spike up because of that. Do you think, because he did dissent, that actually his chances are in fact better today than they were 24 hours ago?
I have no insights on who will be the next Fed chair. I mean, really, the market, the prediction market response, that makes a lot of sense. And yes, he's pushing for cuts, but this has been a really complicated process. The president clearly has struggled to kind of come up with the person that he wants to see in that Fed chair position. I think big picture, we should step back. Yesterday, it was a 10-2 vote in terms of pausing. The Fed chair is not the swing vote on the committee, right? Whoever goes into that position, there would have been a pause yesterday. So I think, I understand the speculation and maybe it did help Waller's odds yesterday, but we want a Fed that's focused on the economic conditions and making its decisions, and pulling the politics into it any more than is absolutely necessary. It's a really risky path for us to go down.
Claudia Salm of New Century Advisors. Claudia, thank you. Appreciate your words of confidence in the governor, Chris Waller. He has such an extensive, deep, credible body of work that he deserves the benefit of the doubt. If he wasn't in the race, would he still vote for this rate cut? Based on recent communication, probably. Based on the interviews we've had with him, likely. He's worried about this labour market. And guess what? Consumers are too.
Yeah.
They're telling you in a recent survey.
Yeah, and he's been saying you've got to follow what they're doing, and you start to look at some of the job cut announcements, and that would seem to fortify it. The bigger question is, why didn't Stephen Myron go for 50 basis points? Because that seems to be his modus operandus. I mean, that honestly, sort of interesting. Maybe he's out of the race.
I also thought of that. But Neil Dutta says this does keep Waller's chances alive.
I'm sure it does.
In the Apprentice Fed edition.
I'm sure it does. And we get another, how many episodes?
Multiple, I think.
Right?
Yeah.
Maybe a few more seasons.
Yeah, true.
This is going on for weeks and weeks,
So
months
exciting.
and months. Tom Becker of BlackRock joins us next. Jeanette Lowe of Strategas, Krishna Gua of Evercore, Matt Hornbeck of Morgan Stanley, the second hour of Bloomberg Surveillance, just around the corner.
The This is going to be, as we all know, a really interesting week for tech.
It's more about tech than it ever has been.
Investors are starting to demand a little bit more.
Anytime you have a technology shift, you're going to have big winners and big losers.
The big question is, can we still see the degree of margin expansion out of the tech names?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your price action looks like this. The rally resumes. Equities on the S&P up by 0.2% on the S&P 500. Likewise on the NASDAQ 100 up by 0.2. Later, a big afternoon for the NASDAQ and big tech. Apple reporting after the closing bell. Later on this morning, about 90 minutes away, another read on the labor market. Jobless claims in focus at a time where Chairman Powell is encouraged by the recent data.
Honestly, what will jobless claims actually mean at a time where we might see a low firing rate, but the hiring rate is so low? There has been an absolute somnolence in the jobless claims. It has remained around 200,000 for a long time. A real question of what kind of signal comes from this at a time where the labor market is not cohering with the growth profile that we're seeing in this country. I mean, really, that is one of the key conundrums and features of this particular growth picture.
GDP sky high, payrolls growth super low, rock bottom. There are reasons for that on the supply side. We've talked about them extensively, but there is something else going on here. Attitudes to the labor market are pretty negative right now if you survey consumers. I keep going back to the words of Diane Swonk of KPMG just yesterday. Diane Swonk is talking up the prospect of an economic boom with a jobs recession. Now, to get philosophical, what is an economic boom if there is a jobs recession?
It means Home Depot is cutting 800 jobs. It means Amazon is cutting 16,000 jobs as they look for efficiency and try to shift into other things. Productivity is a fairy dust. That's what we heard just earlier from Ed Yardeni. A fairy dust for who? For profitability, not for sentiment, for people who are concerned about what their future looks like.
We're just insulated, flattered by massive spending coming from some of the biggest companies on the planet right now. We saw the CapEx figures yesterday. You're seeing it in copper this morning, up 6%. You see it in the numbers from Caterpillar, upside surprise after upside surprise. You're seeing it everywhere at the moment.
There were decades where rates were around zero and it was a financialization of the world. This is the revenge of the fiscal world in every which way. CapEx, metals, everything. You need to actually create a world that can match some of the hopes and dreams that are coming from the AI space and technology. Question is, what does that look like in terms of inflation? What does that look like in terms of jobs growth? And what does that look like in terms of some of the financial instruments that are funding it, including, for example, debt?
And also you have Tesla coming out saying they want to make a domestic fabricator. They want to make chips inside the United States overnight. Jensen Huang is in Taiwan. He's talking about the fact that actually what we're trying to do, there is not enough energy for it right now. Not in the United States, not in Taiwan, not in Europe. Maybe in China, because they have been hoarding minerals and energy for decades. But in the rest of the world, this is going to be a real constraint and a real problem.
Speaking of energy, there is a big rally developing in crude so far this week, kind of under the radar and not talked about much. Guy Johnson out of London doing a fantastic job early on this morning, going through some of the moves, I think up 6% so far on Brent and WTI. Yes, there's an Iran story here, but there are consequences with Brent back to 70 and WTI up to close to 65 on my screen.
Yeah, some of the highest levels that we've seen since last September as that armada gets closer to Iran, and there's this question about what kind of disruption there could be. This is sort of the one aspect of this whole upswing that we've seen in growth. It has come on the heels of lower gas prices. If that changes, how much does that potentially eat into some of the narrative?
And lower gas prices are certainly needed right now for this economy, especially when you look at the conference board and how individuals are struggling still, they say, with everyday goods and prices. And electricity prices, especially in this cold front, are so much higher. At the minimum, you need the lower gasoline prices. And right now, with Brent ticking a little bit higher, that's going to make that story a lot more challenging.
We've said this a few times. Tax refunds, stimulus for the utility companies. We've got to pay some big bills in the next few months.
Which is the reason why there's an increasing focus in getting some of the AI companies to pay them. But yeah, if you look at energy prices and how much they've increased when it comes to electricity, and I'm telling you right now, kids are cranking the heat and I'm not pleased about it.
Yes.
You sound like my dad
when you leave,
I
do you turn the thermostat down?
You have to turn it down. 60.
Even though you leave the kids there, 60.
I think
60.
It helps people sleep better.
My goodness.
Get used to it.
Okay, all right. Coming up on the program.
It's brutal.
Tom Becker of BlackRock as big tech fuels the equity rally. Jeanette Lowe of Strategas as Democrats demand an ICE overhaul. And Krishna Gua of Evercore as Chair Powell insists Fed independence is intact. We begin this hour as the stock rally resumes as big tech ramps up spending. Tom Becker of BlackRock writing, the finance literature is replete with historical episodes of CapEx overinvestment. We are neutral directional stocks with reduced exposure to US equities. Tom joins us now for more. Tom, good morning.
Morning, John.
Is that what this is? A massive overinvestment spree?
Some of it is going to likely be overinvestment. I think a lot of it is very valid investment. So the great power rivalry, that's happening separate from the AI build out. You've got multiple companies that are competing to kind of be the next winner of the AI race. So they're all building kind of the supply that they need. And if it's a duopoly or a monopoly in the end, and you have 5 companies, 6 companies globally all investing to kind of be the winner, you can potentially have a setup in a few years where it's sort of like global crossing, where you build all this capacity and all of a sudden, the price of the capacity drops. That's great for society. It's great for the economy. But I think we're kind of still early innings in that investment cycle.
What do you think the stock market opportunity is right now?
So we're neutral on directional stocks. We think the dispersion is much more interesting. What you were just talking about, kind of energy prices flat, chips up a lot, metals up a lot. You've got countries year to date, Korea's up 25%, Germany's flat. So the dispersion that we're seeing in cross-country equities as kind of these terms of trade shocks, as these competitiveness shocks, as the tariffs kind of bite for some of the companies that are trying to export and don't have a leg up anymore, we think that's where we can really kind of add value to portfolios, is sort of playing for the winners versus the losers.
I want to dig into this idea that you were just talking about, how it's sort of this overbuild, or at least building very quickly, trying to pay whatever you need to pay in order to get capacity to meet demand. Who do you think is most susceptible to overpaying in the short term for something that will become increasingly commoditized in the long end? Is it the hyperscalers? Is it some of the other potential tech players?
I think it's super unclear how it shakes out. Typically, Jensen said, the cost of the compute keeps coming down. The demand for it keeps rising as kind of companies look for new ways to deploy it. But then there's the parallel set of investments related to kind of the NATO expansion, U.S. versus China. You've got, real capex going in the ground for factories, but also for rearmament, for kind of duplication of different countries that, felt like maybe they had an alliance that was a certain way, and now they want to have their own means of production. And so I think all of it is going to play out over multiple years. And so we're still, the capex is what's driving the cyclical growth. And like we were talking about, the consumer may not be happy with the high prices, but they're still spending. And I think the companies are still going to be competing to win. And so it's the competitive spirits, I think, across countries and across companies that's going to propel growth.
How do you identify winners in terms of regions? Do you just follow government spending? Do you follow, in terms of what kind of stimulus each government wants to provide to their sector?
Yeah, so 10 years ago, we were in a monetary dominated environment. And so you really cared about what every central banker was about to say. And, rate differentials at the front end were what it was all about. It really is the amount of fiscal insights that we've added to portfolios in the last 5 years. It's been the whole research agenda has been understanding where the deficit's going to rise, where the country's going to term it out versus issue at the front end, where is the spending have a higher multiplier versus a lower multiplier. So tax cuts, some of the OBBA is going to go to consumers. That's a pretty high multiplier. The corporate tax cuts are a lower multiplier. So one is going to be more the financialization you were talking about, Annmarie, and the other is going to be kind of another stimulus and injection into the economy. Similarly, in Germany, it took them a really long time to kind of ramp up. It's a year on, and now they're finally saying, okay, you can spend some money on this. But it's coming. And so last year was a bit of a fiscal pullback. And this year, you've got kind of a coordinated developed market fiscal thrust. Japan with kind of the consumer tax cut. There's just a lot of fiscal coming back into the system when growth is accelerating.
And at the same time, the dollar is weaker. Has that changed how you're thinking about where you should be allocating money?
We've been underweight dollars for a couple years. We think kind of the global rebalancing that's coming with kind of some of the changes in trade balances. So under the old system, everybody was kind of trying to keep their exchange rates undervalued and sell their exports to the U.S. consumer, kind of the consumer of last resort. And they wouldn't recycle their revenue back into their own currency. So they're all keeping their currencies low, keeping their financial assets in the U.S. We think the incentives here with U.S. hedged yields being really unattractive to foreigners, other yield curves being really steep and attractive. In Japan, why would you buy a hedged treasury? You can just invest in a dislocated, 20 or 30-year government bond. Same thing in Europe. And so we think some of the pullback of kind of that old order of kind of recycling surpluses back into U.S. financial assets, that's just going to moderate, and that's going to be kind of pressure on the dollar to just equilibrate lower.
And I'm guessing you didn't hear anything from the president that made you think that he's going to come out and get in the way.
I think so. You heard something from Jay Powell yesterday, which is
Treasury
the
deals
Treasury.
with that. I think we heard nothing from him.
Well, the first 4 or 5 questions you heard nothing, and then he got going. But I do
sort of. It was boring.
I do think kind of where the dollar settles for kind of U.S. competitiveness is really first order, and so. Tariffs are part of the agenda, but a weaker dollar is also part of the agenda, I think.
I know this is exhausting, but when was the last time markets were this interesting?
It's super interesting because the dispersion is very domestically oriented, kind of that fiscal question. Countries are trying, it's the Carney speech, right? So you've got countries trying to decide, how am I going to navigate this? I'm going to change some of my domestic policies. I'm going to make some alliances. I'm going to make some trade deals. You've got kind of, corporate champions that are being played by different countries to try to kind of bolster their domestic outlook. And so I do think the dispersion is really much higher.
The character of financial markets has changed as well. I'm finding it absolutely fascinating. These used to be cyclical bellwethers, things like Caterpillar, copper, the Kospi, South Korean equities. Now they're secular stories. And it's really confusing. Payrolls used to be a fantastic macro indicator that influenced people's views on how the equity market would trade. Hopeless in the last 12 months. It's driving the Fed, sure, hasn't really driven equities at all.
If you just take that one step further, the Fed used to be a big macro indicator. Now it's the earnings from Microsoft and Meta, even more so. And so it raises this question of how do you get signal from noise at a time where all the signals are changing and the noise is mounting? And that, I think, is what people are looking at, these specific stories, the fiscal, the specific national champions.
Then you've got this big spread opening up between growth and how people feel about that growth. The tension in between is where the politics is playing out, the remedies being introduced to address that. It's a pretty crazy time, let's put it that way. Tom, it's fantastic to see you.
Good to see you, John.
Thanks for dropping by. Tom
Thank
Becker
you.
of BlackRock. There's so much to think about in this market. I have to say it's the most interesting financial market for me, never mind the pandemic, maybe since the Eurozone debt crisis. Different moment, but really interesting moment.
It's a transformative moment, one that historians are going to look back on and really pin an entire new regime. And we talk about Bretton Woods Accord. This is going to be that type of shift on a whole global scale.
Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Comcast reporting a higher than expected drop in domestic broadband customers in the fourth quarter. The telecom giant says it lost 181,000 customers, a 30% dip versus a year ago. Comcast's streaming service Peacock also missed estimates. Shares are in the green. Meanwhile, Tesla shares are also in the green, up 2.3%. The EV maker announcing $20 billion of spending this year to streamline its EV lineup and shift resources towards robotics and AI. Elon Musk's company is discontinuing its Model S and X vehicles. It also plans to invest about $2 billion in Musk's XAI. And NVIDIA, Microsoft, and Amazon are in talks to invest as much as $60 billion in OpenAI as part of a new funding round. That's according to the information. The startup is looking to raise at least $50 billion in the round at the valuation of up to $830 billion. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, negotiating in Washington.
If there are things that the Democrats want that the administration can agree, with them about, then let's do that.
Senate Democrats are united on a set of common sense and necessary policy goals that we need to rein in ICE.
A conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning. Stocks are up by 0.2% on both the S&P 500 and on the Nasdaq. On the Russell this morning, small caps up by 0.4. Under surveillance this morning, negotiating in Washington.
A government shutdown is not in anybody's interest. If there are things that the Democrats want that the administration can agree, with them about, then let's do that.
This is not border security. This is not law and order. This is chaos. Senate Democrats are united on a set of common sense and necessary policy goals that we need to rein in ICE and end the violence.
So here's the latest this morning. Senate Democrats and the Trump administration making some progress in talks, aiming to avoid a partial government shutdown. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John, good morning. Well, it's our understanding that progress is being made towards a potential deal. We could be headed towards at least a short-term shutdown just based on how the calendar is working out. Now, it appears the agreement that's emerging would strip out DHS funding and allow lawmakers to pass the other 5 appropriations bills. There's also talk that we could see what's known as a short-term stopgap measure to fund DHS in the meantime while they work out a broader, longer-term agreement. Now, Democrats have outlined their full list of demands. This does include body camera mandates, new warrant requirements, a uniform code of conduct for federal officers, and an end to immigration sweeps. But it's not clear what the White House will agree to. And the real issue is, even if there is an agreement, this plan is going to require it to be kicked back down to the House no matter what. And lawmakers in that chamber are out of session and out of Washington until next week. And the funding deadline is this Friday at midnight, which means that we are likely looking at a lapse in funding at least over the weekend, and the House gets back into town. Plus, there's no guarantee. I'll point out that the House is even going to get behind this plan. We're already starting to hear from some House conservatives that are making some demands of their own. Though, of course, if it has the White House's backing, that would pave the way. But unless another solution emerges, that could be the pathway that we're headed down. I will quickly add some of those other solutions could be a separate legislative vehicle or executive action. But Democrats have maintained that this is their best way to maintain leverage by tacking it on to this legislation and threatening a shutdown. John, I will say I was on Capitol Hill yesterday, and the overwhelming sense was at least these two sides are talking, compared to the last shutdown where it seemed like they weren't even going to engage, perhaps giving us a little bit more insight into how potent a policy and political issue this is now becoming for Republicans.
Tyler Kendall, thank you. Tyler, down in the nation's capital in Washington, D.C. To build on that, Jeanette Love, strategist, writing this: any shutdown would likely be short-lived, or short-lived, as Chairman Powell once said.
I think we need no, short-lived.
Okay, all right.
That was a short-lived issue.
Thank you.
Pronunciation.
Short-lived, particularly if the Senate does not strip out the Homeland Security funding bill. Jeanette joins us now for more. Jeanette, apologies for getting off track there. Let's get back on track. Going into the weekend, is this shutdown avoidable?
Yeah, I mean, it looks right now like we're going to, again, as Tyler mentioned, have a short-term shutdown over the weekend, which would be less impactful than obviously if it was lasting much longer than that. There is this issue about the fact that they are not going to do a separate legislative vehicle. As Tyler said, it does seem like the Democrats want to use the funding bill as the vehicle for some of these changes on immigration enforcement. And so that's why we're probably going to have this shutdown. Now, obviously, this could, we could have at least a continuing resolution to cover the Homeland Security bill once the House comes back in on Monday. So this could be very short-lived. It could last only 3 days. But obviously, depending on how this plays out, this could have big implications. A shutdown would only be a partial shutdown. 6 appropriations bills were passed, but this is still about 75% of the government funding, and it includes important things depending on how this plays out. Do they pass the defense spending bill? Because we obviously are trying to threaten Iran with action right now. So that is not exactly good to have a shutdown when we're trying to have a very strong U.S. national security strategy. What happened to IRS funding? We're in the middle of tax refund season, so that could have a really big impact. And then obviously labor as well. So if that's not taken care of, we could actually miss another jobs report at the end of next week. So I do think that Congress has been on a path to avoid a shutdown. They will probably try to get these 5 bills passed immediately and get that taken care of. And then we'll be dealing with this Homeland Security bill, and it would be a partial shutdown that may last hopefully just a short amount of time, and that is our overall thinking.
Well, let's deal with the Homeland Security bill, because that's going to be where the huge debate is going to lie. What is Senator Schumer actually asking the Republicans to amend in that bill?
Yes, I mean, they want to obviously tack on some policy provisions, as Tyler mentioned, where they want to make sure that there's no use of masks, there's the use of body cameras, there's a code of conduct, things of that nature. So obviously this would have to go back to the House. There was some options. You heard some Republicans saying that they were open to this, but then you've started to hear others start to say that there have disagreements, particularly about like the mask issue and things of that nature. And so this could be a little bit of a friction point, but obviously the administration does know that something needs to be done in the wake of what's happened over the weekend with the shooting of a U.S. citizen. They do realize that they need to make some changes here, and so I think they will ultimately push to get this bill done one way or another.
Jeanette, though, if the Republicans do decide to go along with these Democrats' wants to pass that bill, are they basically acknowledging then that their strategy when it comes to DHS and ICE hasn't actually worked?
Not necessarily. I mean, I think you've heard from a lot of Republicans the way they've framed the issue, that they can say that, there's been less safety for everyone involved. There are ways that they can show that just the tactics have maybe become a little bit too strident and they need to make some changes. So I think that they can do this in a way that creates not a losing message for the Republicans.
Jeanette, is it a good strategy to hold government funding hostage to try to get some leverage? I mean, this seems like voters are not particularly pleased with that. The last time around, it didn't really work out for Democrats. There were a lot of concerns around air traffic, and we're still trying to work through the lack of data releases. I mean, is this something that's sort of running out of power in terms of the voter base?
Yeah, I mean, one of the things that obviously when we came into, let's say last Friday, there was an effort to have this bill done, have funding completely taken care of before the deadline tomorrow evening. But what happened with the shooting was obviously a stark change. It created the need to find some sort of leverage to change tactics. Otherwise, I think both parties were completely against having another shutdown. They felt the pain on both sides of that 43-day shutdown that we had last fall. But there is the concern, obviously, that if they try to do a separate legislative bill, there's worry that maybe it passes the Senate, but it never passes the House. And so there's also this fear that that ruins their own leverage on the Democratic side if they have to give up the option to try to hold the government funding hostage. Obviously, I don't think people would want a long-term shutdown. I don't think the White House, the Republicans, or the Democrats want a long-term shutdown. I think they do want to find a solution here, and hopefully this will just last a few days to get this over the finish line.
Jeanette, you mentioned something else, that the administration understands that something needs to be done. I just wonder if you expect other personnel decisions to be made from either the cabinet level or beyond to try to address some of the unrest.
I mean, it's obviously always an option. Can't necessarily say whether or not we see that happening at this time. Obviously, the one big move is to move Tom Homan into Minnesota. That was obviously a strategic decision to try to change the tactics that are being used and to do some de-escalation. We'll see if other things come out of this. Obviously, it's been just a week. We'll have to see how some of this plays out and see if there are other ramifications that happen down the line.
Jeanette Lowe of Strategas. Jeanette, thank you. I don't think you can overstate just how popular the president's push was on immigration in the election and how deeply unpopular the execution has been over the past month.
Yeah, people were really for this whole idea of cracking down on immigration, and there was a feeling that the border was really open. And now, as people see these images, it has flipped completely. If you take a look at the approval of ICE has gone down dramatically. So you start to wonder, at what point does that force some pretty big changes at the leadership of ICE, but also just potentially the approach that they're taking?
They've lost the argument here so quickly. They did such a tremendous job of shutting down the southern border, and then this. And the imagery of the past few weekends, not good.
It's not good. It's not what Americans want to see. And you could see this, along with the president's overall approval rating, is now tracking lower. And you have senators like Tom Tillis saying individuals' heads need to go, like Kristi Noem.
Up next on the programme, coming up, we'll catch up with Krishna Gua of Evercore on the future of Fed independence. Plus, Yahira has some morning movers. Check out Caterpillar this morning, rising on a big earnings beat. Their stock is up by 1.3%. Equities positive by 0.2% on the S&P 500. The Nasdaq higher, some outperformance on the Russell. That's the story of the year so far for small caps. Not the story of the past few sessions, though. Small caps up by 0.4%. As we count you down, let's get you some morning movers with more. Here's Yahira. Hey, Yahira.
Hi, John. The AI spending race is splitting the tech giants this morning. We're seeing Meta shares up nearly 9% in the pre-market as investors give it a pass to spend big on AI, up to $135 billion worth, because the payoff is showing up when it comes to improved ads. So Microsoft not getting the same pass. Shares are down 7% as investors scrutinize its record AI spending. And speaking of all that CapEx, well, someone's got to build it and power it, and that's where Caterpillar comes in. Shares are up 1.25% in the pre-market. It posted a strong beat in the fourth quarter as the industrial giant now becomes an AI play. A surging electricity demand from data centers is lifting its power generation unit. And we end on some fun with Royal Caribbean. Shares are up 7.5% in the pre-market. It was a beat and a raise for the premium cruise line, as the CEO says about 2/3 of 2026 cruises are already booked, and that momentum continuing into 2026, according to him. We'll see if we see the same strength from the non-premium cruise lines amid this K-shaped economy. But for now, people want to be at sea. John?
Who are these people? Who are they?
I think it's you.
Right?
So you could do 7-night perfect day Bahamas cruise starting for $859 a person. I mean, I could tell you, go to Nassau, perfect day at Coco Cay.
That sounds terrible.
Sounds completely your speed, John. I think you should go there.
Is there a premium cruise line?
Yes, it is. It's called.
Yeah. Is there?
Yeah, you do a river cruise.
Yeah, it's
you
called
do for the fjords.
Chartering a yacht.
I've acknowledged that's the one thing I would do.
But,
that's my premium cruise as
yeah,
well.
you charter your own yacht. That is a premium cruise.
I think Coco Cay has your name written all over it.
Okay, I'll make that happen.
I think you should.
Yeah, all right. How much is it?
That is $800.
That's
it starts
what's
at
going to shock me. That's what's going to shock
$859
me.
per person. $1,718 total per room.
Gets
That's
expensive quick.
Yeah, exactly. I mean, but it's all inclusive, so
That sounds
you can
exciting.
have a
For
lot
a
of
man that doesn't
flavor.
drink too much, I might take up drinking if I have to go on a cruise. And I read out this morning, President Donald Trump issuing a warning to Iran. Make a nuclear deal with the US or face military strikes. Iran saying it's ready for dialogue, but that it will defend itself. The tensions pushing Brent crude back towards $70 a barrel. Crude up by 2% this morning. Elsewhere, Nvidia CEO Jensen Huang saying customers in China have yet to place orders for H200 chips. Huang adding Beijing has not decided on allowing the chip makers imports. The comments coming after Nvidia's CEO met customers and government officials in China. That name is down about 0.2%. And finally, the New York City mayor Zohran Mamdani asking Governor Kathy Hochul to hike taxes for the richest residents and corporations. Mamdani arguing that the additional money would close the city's budget gap. Hochul insisting she would not raise taxes.
She was asked about this yesterday in an unrelated press conference, and she said, "We're not raising taxes in the state of New York. I'm not raising taxes for the sake of raising taxes." He's been saying it since he was running for office a year ago, so I don't know what the news flash is. Talking about the strong partnership that she continues to have with the mayor. Look, she's running for re-election, and if she raises taxes, well, I guess that we are going to have a Republican as the governor of this state, and I think that that really is the tension. How feasible are some of these proposals coming from Mayor Zohran Mamdani?
Please don't confuse this with an opinion, because I don't have any. But does Governor Kathy Hochul have a credible position on anything? On anything?
So there is a question. Are you saying that she would raise taxes, or that just she doesn't have a position on?
The last time we had this debate in Midtown Manhattan about a congestion charge, she changed her mind pretty quickly, right? And that was in the lead up to an election.
So it sort of raises the question, how much is the election going to determine her position? And right now, the election is going to determine that she's not going to raise taxes. And that ultimately is what people are betting on.
And then what happens next? Isn't this just the direction of travel for New York? Isn't this where things are going?
If it's not this year, it might be the following year, yeah. But we always have this budget dance between the city and the state. He has to come out and say that he's going to get this done. But Kathy Hochul is saying, she's been saying for months, I can't lose any more people to Palm Beach, because she sees the capital flight. And this would be the best opening you can imagine from the Nassau County executive, Bruce Blakeman, who's running and is backed by Trump. And they are going to do a ton of press around this if she ever entertains the idea of raising taxes for New Yorkers.
It does raise a question. If Mayor Zohran Mamdani was so popular to get into office, how much of a groundswell of support is there for some of these proposals on a broader level? And at what point does the electorate start to push for some of these types of measures? And I do think that that is a broader point that has to be recognized, especially given the fact that we haven't seen consumer sentiment this low since 2014. So you start to wonder, yes, you could say, well, it's not going to happen, so forget about it, ignore it. But this push for higher taxes to fuel some of the proposals that we're hearing, like free childcare, like free buses, like free a lot of things, there is a question of whether this is the path of travel. And I think it's decent to bring that up.
Feels like that's the direction of travel at the moment. Matt Miller, I'm going on a Disney cruise next month. So Matt.
Is he really?
Matt is that guy.
But he has kids, young kids. And if you have young kids and you want to just check out while they run around the pool, I get it.
But we all know for Matt, a Disney cruise is probably actually for him.
It's for Matt,
He's
not
the
the
biggest
kids.
kid of all.
It's for Matt.
Yeah,
you ever been to Matt's house?
No.
Open up the cupboards. There's
Mickey
just
Mouse?
cereals and like
Lucky Charms.
candy and stuff. And that was when he didn't have kids.
Reese's Puffs.
Okay.
It's like my dad.
Yeah. Let's turn to the Federal Reserve. Fed Chair Jay Powell defended the central bank's independence.
And we haven't lost it. I don't believe we will. I certainly hope we won't. But it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Powell warnings his successor to, quote, stay out of elective politics. Krishna Gua of Evercore writing this: in voting to cut, Waller stays in the competition for the chairmanship, even though the odds currently favour Rita Walsh or even a reset to try to persuade Besant. Krishna joins us now for more. Krishna, welcome. We'll talk about some of the substance and the economy, but I do want to pick up on this story of who's taken over the Federal Reserve. You've seen these twists, these turns in previous runs to replace the Fed chair. What's unique about this one?
Oh, where do we start? I mean, this is a chair selection race like none before. Obviously, first and foremost, because the president has such strong views about monetary policy, but also has strong views about the relationship between the central bank and the administration. So all eyes on this to an extent that we've never seen before. The search itself has been very interesting, right? We have come down to this short list of candidates, but we've seen different candidates that look like they were in pole position and then fade. First Hassett, then Walsh. Now Rita is being talked about as the guy who's maybe in pole position. But we haven't yet seen a definitive convergence on any of those candidates. Waller's still in the running. And as I wrote, just some chance that Trump's roving eye is telling you he's not completely sold on any of these guys and might yet hit reset and try to have another go at Scott.
Krishna, this seems to be what a lot of people keep coming back to. We've heard that from Neil Dutta over at RedMac as well. I do wonder how relevant it is who the pick is, given the fact that Senator Tom Tillis of North Carolina said that he wouldn't pass anyone through the nomination, the confirmation process to be the next Fed chair, as long as this subpoena was outstanding of the Federal Reserve.
So you're right that is obviously an important impediment at this moment. I think the sensible path, and we're not in a world where sensible paths are always the ones chosen, but the sensible path here will be for the DOJ to quietly close out that investigation around the time that the new nominee is put forward, so that the new nominee has clean sailing in the Senate. And then, of course, the greatest possible ability to influence the Fed in the direction of deeper cuts, which is, of course, what the president's actually shooting for.
Krishna, how can a Fed give forward guidance if we don't have a sense of what the reaction function is of the members, because we don't know who the members are? I mean, how much does that really hamstring one of the main tools that the Federal Reserve has?
So super important point. And I think the short answer is anything that the current chair, even more broadly, the current committee to some extent says right now, you have to take with a little bit of pinch of salt, because it can really only provide maximally credible guidance from here up to May, when Powell steps down as chairman. So I think that's how we should interpret what we heard from the Fed this week. The Fed is clearly indicating that they're comfortable in a potentially extended pause posture. And why wouldn't they be, right? Growth has stepped up. It looks like the labor market is starting to stabilize. We've been saying this for a while. Came into the year with an above consensus call on growth. The underlying inflation picture, I would emphasize, Powell also emphasized, is still looking pretty good. And I think that still holds out the prospect for some cuts later on in the year. But I think the way we should read Powell and the current committee is saying, doesn't look like we'll be doing anything much this side of May. And they're being very circumspect as to what will happen from the summer onwards.
Krishna, do you think he leaves in May, or does he stay on as a governor?
So if you'd asked me that question before the subpoenas were issued, I would have said strongly likely that he leaves. I think one of the aspects of the stupidity of that move was that it backfires against the president's own interest by making it more likely that Powell stays on as a regular governor, because he can't be seen to be yielding to that pressure.
Right,
now,
but we just heard a clip from him.
Therefore, it's kind of endogenous from here, right? If the administration de-escalates in a sustained and serious way, I suspect he still goes. But if they don't, he won't.
Sorry, Krishna, but we just heard a clip from him, Jay Powell, saying he's committed to Fed independence. If he stays on,
Yes.
Isn't he also showing that he is very political as well?
Not really. I mean, I think the most important thing at this juncture is that Powell needs to make it absolutely clear that the administration is not able to push out Fed officials by using DOJ investigations against them. That is the most important thing in this particular moment. Now, as I said, if the DOJ is smart enough to close out that investigation, and if in general the Trump administration sees the wisdom of de-escalating from here and backing their guy for success, then you've still got several months to go to May. You could end up with a situation where Powell can indeed walk away in good conscience.
It's such a shame, Krishna, that this has become such a big distraction, because there's an important economic debate that needs to be had. Many people on Wall Street are expecting growth to pick up, and at the same time they think inflation will be contained. You yourself say the economy will be stronger, not hotter. How convinced are you of that for the year ahead?
So I think this is absolutely a strong growth year. And as again, we have had an above consensus forecast on growth for 26 all along. The issue is really this debate. Does stronger mean hotter, or does stronger mean not hotter? Now, I'm in the second camp, but we're going to be pragmatic and have to listen to what the data tells us. Why am I in the second camp? First, because I think a big part of this story, the dominant part of this story, is a step up in productivity. It was very interesting to see Powell turn to that when he was asked about what are the implications of stronger growth. It depends on whether it's driven by and accommodated by productivity or not. I think all the data right now is still very benign on the inflation front. I expect that to continue, but I'm going to be on the lookout for any signs that I'm wrong. One thing to watch, of course, is whether unemployment stabilizes and drifts down a bit, which is my base case expectation, or instead starts to plunge on this faster growth. If it's plunging, that's suggesting the neutral rate is higher than we thought. That would be the case where there isn't really room for cuts. But right now, I still think that you've got a pretty good bet of getting 2, and you can still have a shot that the new chair can even get you to 3.
Krishna, thank you, sir. Krishna Gill there of Evercore. That last point is so important. It's just such a shame we're distracted by all of this nonsense in Washington when that's the conversation we should be having.
Yeah, productivity is the fairy dust that people are looking for. And the question is, do we have that, or do we have a boom that's going to come with inflation that needs to be tamed? And ultimately, that's what people don't have an understanding of. And if you really were confused enough, we don't even have the data necessarily. And we could be heading into another shutdown. We're just working through all of that. So, yeah, exactly.
Let's not do that.
I mean, that's what I was thinking. I mean, I'm just thinking about Ed Bastian and Scott Kirby over sitting there. Why us? Why keep attacking
the economists? They might not get the jobs report.
Why keep doing it? Wall Street problems, right?
Yeah.
Lack of data, all that stuff. All right. Matt Hornbeck and Morgan Stanley is going to join us in just a moment to talk about that. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Well, we may avoid a shutdown. President Donald Trump and Senate Minority Leader Chuck Schumer moving toward an agreement to avoid that government shutdown. The New York Times reporting the two sides are close to agreeing to Democrats' demands to remove long-term Homeland Security funding from a massive spending bill to keep the government open past Friday. Meanwhile, Starbucks reporting stronger than expected growth in its fiscal first quarter and a solid outlook for the year. Global same-store sales climbing 4%, beating estimates. CEO Brian Niccol telling analysts the company has identified $2 billion in cost cuts as it works to streamline operations and improve service. And Jersey Mike's Subs, the sandwich chain with more than 3,000 locations, is reportedly working with Morgan Stanley, JP Morgan, and Jefferies on a potential IPO offering. Sources telling us here at Bloomberg. The company is seeking a valuation of at least $12 billion, and more banks are expected to be part of the lineup. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next, the case for holding.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. There was broad support on the committee for holding.
Matt Hornback of Morgan Stanley joins us next. Equity futures positive by 0.1% on the S&P 500. On the Nasdaq, just about in positive territory. Under surveillance this morning, the case for holding.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. Available indicators suggest that economic activity has been expanding at a solid pace. There was broad support on the committee for holding.
So here's the latest this morning. U.S. Treasuries holding steady as the Federal Reserve pauses its rate-cutting cycle. Matt Hornback of Morgan Stanley joins us now for more. Matt, good morning. Good to see you.
Good morning.
How much heavy lifting is 1 month's data doing for the Federal Reserve?
Well, it seems like quite a lot. I would not look at a chart of the unemployment rate and see it tick down once in a very clearly defined uptrend and call that stability, personally. You can look at the U6 measure of unemployment. It did also tick down, but it is also very clearly still on an uptrend. So I'm a little bit boggled by that definition of stability myself, but to each their own.
But you are forecasting strength this year in the U.S. economy.
Absolutely. I mean, I think our economists look at the situation, they look at the fiscal impulse, they look at the AI CapEx spend, and they see signs of strength. And by the way, I mean, the U.S. economy is not weak. If you look at final domestic demand, you can see that the economy is in fact operating just as it had prior to the pandemic, which means strength. But it doesn't mean 4%, 5% strength.
Why is that wrong? Why is that misleading?
Well, one of the quirks in how the GDP accounting ends up coming out is net exports. And net exports involves imports. Imports today are adding to growth, and usually they subtract from growth. But the reason why imports are adding to growth is because of tariffs. And it's because we aren't importing as much as we used to as a result. So we actually have a situation in which the underlying economy is in fact just fine, but it is just fine in the context of where we were before the pandemic. And if you recall where we were before the pandemic, we had 2% real growth and we had basically 2% inflation. It was actually a little bit below 2% inflation on core PCE. So this actually all aligns with how the Fed, I think, is generally thinking about the U.S. economy. But don't look at the Atlanta Fed's GDP Nowcast, which everybody does, and be hypnotized that something else is going on. The economy is just fine.
Well, if the economy is just fine and unemployment rate, you think that stabilizing is the wrong way to maybe characterize it, how much more room for cutting do you think that there is? I mean, do you think that right now this Fed is underestimating how much they really can continue to slash rates?
This is a question about where is equilibrium in the economy, both in terms of growth and inflation, as well, and importantly, with interest rates. And when we look at what's going on with population, in fact, the population estimates were just updated yesterday. And when we look at those, it leads us to believe that trend growth, potential growth, is probably coming down. And so if trend growth is coming down and we are in a pre-financial crisis world, then so too is R-star, or the real equilibrium interest rate. And as that comes down, the Fed can continue to lower interest rates. In fact, they would have to continue to lower interest rates just to maintain the current level of accommodation in monetary policy. So there is definitely scope for them to keep cutting rates. our economists, as you know, led by Michael Gapin, is looking for 2 more rate cuts this year. It's 1 more than the Fed, and it is about the same as what we have priced into the markets today.
But there was no sense of urgency to what you're outlining in the press conference yesterday. Are you surprised?
Well, it's not clear that there needs to be an urgent set of rate cuts, right? These concept of potential growth, equilibrium interest rates, they move very slowly. And so it makes sense that the Fed may be taking its time lowering interest rates. It needs to figure out over time where is the equilibrium interest rate in the economy. But we do have data coming up, as always, and the BLS is making a change to the labor market report that I don't think that many people are aware of, but they're making a change to their net birth death model, which could have implications for how this labor market data ends up coming out this year.
Still, when you look at the consumer sentiments yesterday, the conference board, consumers who said that jobs are plentiful plunged to 23.9%. It was at 28% in December. Based on what Wall Street is saying and what consumers are saying, it's 2 very different economies.
It seems that way. I think one of the problems with sentiment surveys is that we generally don't know how many people respond to them. And one of the things that we have seen since the pandemic, as you're well aware, because you're all smiling at me, is that the response rates to data have come down. So when we think about the S&P Global Purchasing Manager Indices, when we think about the ISM Purchasing Manager Indices, one thing that they don't tell you is the response rate. How many people are actually responding to these surveys, which is why I think they've generally become more disconnected from reality, is because not as many people are responding.
Matt, what's the bond market call now for you and the team?
So we're basically seeing the long-term Treasury yields remain range-bound. But we do think that with more rate cuts will come lower short-term interest rates. So we think the curve will continue to steepen. Short-term interest rates come down. Long-term interest rates remain generally range-bound.
Dollar weaker?
And the dollar weaker, absolutely. That's been one of our core calls for the past year, is that the dollar was in a downtrend. And that downtrend, of course, doesn't happen by appointment. It takes catalysts to cause it to trade weaker. Obviously, what we saw last Friday with the rate checks, both from the Japan Ministry of Finance and the U.S. Treasury, was a catalyst to push the dollar weaker.
Are you expecting some intervention on that side of things?
Well, it's not clear. Well, I would argue we've already seen intervention. It's called verbal intervention. It's not clear that we actually need physical trade-based intervention at this point. The dollar has come off quite a bit. And if the data come in like we think they will, softer inflation over the course of the year, labor markets that generally remain in a malaise, then the dollar continues to go down on the data.
The dog has barked. Let's see if we get a bite. Matt, thank you, sir. Appreciate it. Matt Hornback there of Morgan Stanley. The president weighing in on interest rates. This is what he's got to say on social media this morning. In a statement, Jerome Too Late Powell again refused to cut interest rates, even though he has absolutely no reason to keep them so high. He is hurting our country and its national security.
This is a very long statement from the president. So clearly he's digesting what Jay Powell had said yesterday and once again saying he wants lower interest rates. And the man in charge right now is talking about how actually we're more in balance when it comes to the Fed's dual mandate.
He does have a decision to make. It's the replacement for Chairman Powell, and I don't see that in this very long statement this morning.
No, I'm doing a quick Control F, trying to find anyone's name. Not there
Control
yet.
F, that's it.
Coming up on the program, David Levovitz of JP Morgan Asset Management, Ed Ludlow, Nancy Lazar, and Earl Davis of BMO.
I think it's a Fed that is comfortable with the backdrop of data. The data seem to be improving from here.
They're now in wait-and-see mode, and they're basically waiting to see what's happening on inflation.
There doesn't seem to be the market pricing in a huge risk of inflation going forward.
We know somewhat where inflation is. The markets are extremely confused.
In the next 6 months, there's really no real movement towards a cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 close to all-time highs, up another 0.2% on the S&P, on the Nasdaq up by 0.1. Big afternoon for the Nasdaq coming up. Apple reporting after the closing bell. Your data drops in about 30 minutes time. We'll get jobless claims. Already getting a statement from the President of the United States, a statement on Jerome Powell, the Chairman of the Federal Reserve. Now, the news here is not what he's saying, it's what he isn't saying.
Yeah.
This is the same old complaint about interest rates of the Federal Reserve. The President has an opportunity to announce who the next chair of the Federal Reserve is going to be. And even though he's complaining, he's not taking that opportunity.
I haven't counted all the words, but there are a lot of them. And in this, there are a lot of discussion about the billions of dollars that could come into the U.S. with the stroke of a pen. With more tariffs, there is a lot of discussion about interest rate expense. There isn't any definitive action, which raises a question: how is he going to achieve these lower rates that he's looking for, these lower interest expenses, while getting someone who is credible to markets? This is sort of the person, the unicorn that has not yet emerged.
I think the president is saying to Wall Street, I have nothing for you yet on that. Basically, in the words of Jerome Powell yesterday to all the journalists, it is interesting that we do not have a decision yet for this administration. They keep pushing it back. The Treasury Secretary said we're going to get something before at Davos, maybe a little bit after Davos. Well, tomorrow is Friday of the week following Davos, and we still don't have anything. And right now, given the fact that Senator Tillis is putting this roadblock in the way until the DOJ investigation into Powell is wrapped up, this administration might take a lot longer to mull over their decision and make that announcement.
Mismanage the process, and because of that, it's going to take a whole lot longer. It's kind of out of their hands now. Even if they nominated someone right now, today, nobody can really tell me how long this is going to take based on what the senator from North Carolina told us in the last week.
Yeah, and it doesn't seem like President Trump is backing down from the subpoena of the Federal Reserve, because yesterday he tweeted out a story from another news outlet talking about how the Fed has yet to respond to that subpoena. So there is this question of, okay, they could make this go away by just simply withdrawing some of this request, and yet doesn't seem like that's in the cards, at least not yet.
If the Fed's not complying yet with the subpoenas and they're going to drag this out, at this moment, Powell really is in the driving seat in terms of how long this is going to go on.
Equity futures right now in the S&P still positive by 0.2%. Coming up this hour, we'll catch up with David Lebovitz of JP Morgan Asset Management, with stocks trading at record highs. Nancy Lazar of Piper Sandler breaking down the latest labor market data, and Earl Davis of BMO Global Asset Management saying the Fed's easing window is closing fast. We begin this hour with stocks rising to fresh records as tech earnings fuel investor sentiment. David Lebovitz of JP Morgan Asset Management writing, we see room for growth to be driven by both investment spending and consumption in 2026 as the AI story continues to play out and U.S. consumers benefit from the one big beautiful bill. David joins us now for more. David, good morning.
Good morning.
Consumers feel like crap right now. You can see that in the surveys. It's pretty clear. I mean, really, really clear. Are they going to spend that money in the way you think they will?
So I think that there are two things that are going on here. One, people are going to find themselves with more money in their pocket. Two, affordability is still the biggest issue facing the consumer today. And to my mind, that's why you're seeing the sentiment numbers continue to come in with such a downbeat tone. I think, though, if we see a world where growth begins to pick up, where labor markets importantly begin to stabilize, and where the pace of inflation doesn't reaccelerate, consumers will be comfortable spending. Now, what they spend on, we've already seen people move away from name brand to private label. I think that those trends could very well continue, but it does look like the consumer is going to be a key staple of the growth story as we look ahead across the year.
Does that speak to the outperformance in small caps to start the year? Does that speak to some of the moves we're seeing worldwide, just a pickup in global risk appetite?
So I think part of it is a pickup in global risk appetite. I think part of it also has to do with the fact that we're just looking at a more balanced environment than where we've been over the past couple of years. You know, we've talked many times on this show about kind of the echoes of COVID and how we've seen these mini recessions roll through the economy. You've seen it in housing, you've seen it in services, you've seen it in manufacturing. It feels like everybody is coming back together, right? The orchestra is sounding a little bit more unified and coordinated, and that's why I think you're seeing risk assets in particular, whether it be small caps, whether it be EM, perform well so far this year.
Is this an environment, this is something we were talking about earlier, where equities just will continue to outperform all other asset classes, or debt in particular, given the fact that it's all about growth? It isn't necessarily about disinflation. It isn't necessarily about the financialization of the economy.
Yeah, I think the market has moved past the inflation story, to your point. I think it's all about growth, and it's all about profit growth. And that's part of what has kept us constructive on owning risk in portfolios over the past couple of quarters. Is it is very rare to see a world where the labor market cracks and corporate profits remain solid, right? You would need corporate profits to roll over in order to get concerned about a downshift in growth, and that's just not materializing. And so with the earnings story there, with the economy well supported, and with an expectation that, to the conversation you all were just having about the Fed, we will get some rate cuts this year, right? I think that's what's fueling the appetite for risk. That's what's allowing equities to continue to grind higher. And you look at credit markets and it's like, where do we go from here? 260 on high yield, that's not looking like a place where you can get a whole lot of capital appreciation. And so if you want that upside, investors are being forced to play the equity side of the risk bucket.
HSBC put out a note yesterday talking about how so far this year it has been the Russell 2000, it has been the small caps that have been outperforming, and that's rotation trade that tries to gain steam every beginning of the year seems to have played itself out. They're already shifting back to the mega caps. Are you agreeing with that? Are you seeing this sort of trade as having had a nice month, but now it's time to go back to the others?
So we prefer to lean into the higher quality, larger capitalization companies. We think that that's a better way to play this late cycle environment. And I do think that we are now in a late cycle environment. I think part of what might be supporting small caps and may lend further support to small caps this year is, the return of animal spirits, more conversation around IPO activity, M&A activity, buyout activity, right? All of that is very positive for smaller companies. You then look at the nature of some of the IPOs that are coming, and they're going to be pretty big companies. And that's why I think that you'll see this begin to fade. And that's why I think the opportunity is still in things like tech and communication services.
We build on where we started with the consumer. Wall Street is putting so much emphasis on the tax refunds. What's to say that consumers didn't spend it? They all knew for months this was going to be trickling down, and we just got over the Christmas holiday season.
So the thing that I've noticed about the U.S. consumer is that when they have money, they spend it, and when they don't have money, the credit cards come out. And so I think that's going to be the story this year. I actually think my favorite non-consensus view today is that the risk to growth this year is to the upside. Everybody tells me we're going to have this gangbusters first half of the year. Things are going to fade in the second half of the year. I don't see it. I think people are going to be feeling good. The wealth effect is real. The labor market is going to stabilize. We also have things like the World Cup, America's 250th birthday. There's a lot working in favor of the U.S. economy in 2026. That may well change in 2027. But over the next 12 months, I think that you're looking at a pretty interesting opportunity.
At least it's got doubts, clearly.
Well, 250th birthday party, what? Because everyone's out buying a gift for the United States. I mean, what is
People
that?
throw parties.
You have to
get together.
Yeah.
Well, and
I might throw a party.
Happy birthday, the World Cup. Are people even going to come? I mean, there's a lot of questions here.
I hope they do.
Yeah,
I hope they do.
You're not buying tickets because they're too expensive.
They're ridiculously expensive.
And I think that there is this question about. Look, I agree. I'm just, in general.
I'm waiting for someone to take me.
But it's a very fair point, and that's why we're.
Careful.
I'm not allowed to accept tickets. Don't offer me tickets.
But that's what leaves us comfortable with the outlook. Is the consumer is really only one piece of that puzzle, right? To the birthday point, my guess is that results in a bit more government spending, and then you have the whole AI story that we haven't even discussed this morning. That is something where if you look at the results that we got last night, there is more capex in the pipeline. There is more money that is going to get pumped into this economy.
They're committed to it. They've got the balance sheet to lever up if they want to. They're absolutely committed to it, and you see it showing up in Caterpillar, Copper, you see it all over the place. Let's say you're right. Let's run with that.
Yep.
What's not priced for it? Because equities are leaning that way. What isn't priced for it?
So I think that equities are very much leaning that way. Equities around the world don't look particularly attractive from a valuation perspective relative to their own history, relative to the U.S. And so that's leading us to lean into markets like EM and specifically China. We continue to really like Japan. For us, Europe is interesting because Europe doesn't have the tech exposure. And as somebody who graduated in the financial crisis, I've never really seen Europe work. So recency bias is a real thing. But we think that you can get diversification benefits from owning that market because you're not going to be subject to the same forces and the same trends that you're getting from EM in the US, which are very much focused on
I was trying to get you to talk about bonds, so I'll do it directly. What does it mean for fixed income and bonds? Equities are there. Growth, give it to me. Got it. What about fixed income? Can yields stay this range bound, this stable in the face of a much, much better growth profile?
So I would argue that the risk to rates is to the upside, but I would argue that if you see rates move higher on the back of better growth, that's going to have a very different impact on the equity market than when rates move higher on the back of an increase in term premia, i.e. the government saying something that upsets the market. And so, higher rates from a growth perspective, I think leave equities okay. But for us, you're not really looking at, back to our conversation earlier, significant opportunity for capital appreciation, whether you're looking at government bonds, whether you're looking at credit. EM debt continues to perform well, but the juice has effectively been squeezed out of that orange. And so our view from a credit perspective is you're basically going to get your carry. We have a lot of conviction that you're going to get your carry, but we're not sure that there's much upside above and beyond that. If you want that upside, you have to go to equities, and that's what keeps us overweight equities, neutral on credit, and then neutral on duration as well.
I want to just sum up something that we've been talking about throughout the morning, this idea of how we had the financialization of the markets when you first graduated and you came in post-financial crisis or during the financial crisis. And now we're moving to another phase where this is the real world really reasserting itself in a new way. The CapEx is taking an increasing proportion of growth and, frankly, budget of balance sheets. How different is this investment landscape from when you graduated and from the years and years of 0% interest rates that really fueled a lot of financialization?
So it's interesting because I've also worked on our long-term capital market assumptions for the better part of the past decade. And I remember times where we said the 60-40 portfolio is going to pay you 4% over the next 10 to 15 years. Nobody liked that story. Our number is now closer to 6.5. The reason why is that you have these forces of more active fiscal spending by governments, more economic nationalism. Well, how do you respond to that as a corporation? You invest more money in things that can solve some of the problems that the political sphere is creating. And so I do think we're moving away from this world of financialization. I do think that you're going to see real dollars spent on real things. And I think overall that leaves us in a world where fixed income gives you income, equities give you growth, and when you put it all together in a portfolio, you can actually generate a rate of return that allows you to achieve your long-term objectives.
When governments start picking national champions, do the rules of capitalism still work?
So I think you need to be cautious, obviously, and there are certainly some warning signs in the current environment. But my job is not to pass judgment on whether that's right or wrong. My job is to figure out what to do about it. And so if you have that type of support coming through, you have to think of it. Yes, there is some risk, but there's also opportunity that's being created, which if you let that go by, you're going to look silly.
We've been giving capitalism a beating for a long time now. Coming out of GFC, central bankers kicked it in the gut, and coming out of the pandemic, governments are doing the same thing.
I would agree with that. I think
let's not pretend any of this is,
I would agree with that. I would just wonder if you are operating by a certain rule, a game of rules, do you have to change those rules as an investor and start to shift around your thinking that things won't necessarily make sense in the same kind of way? I'm just wondering how that sort of introduces some new variables.
Totally. Like the government is picking winners and losers.
Correct.
And the last 10 years, central banks just haven't allowed any losers. To some extent.
It's true. No, this is something that a lot of people complain about. Exactly, the beer goggles.
The dynamism has gone away. It's a complaint,
The small businesses.
Yes.
Where are they?
But I think at the end of the day, stock prices follow earnings. And so if you can follow the earnings, regardless of why those earnings or how those earnings are being generated, right, that should work out if you're a long-term investor.
There we go. Sensible, David. Thank you. We appreciate it. We need some of that. David Levovitz of JP Morgan Asset Management. No emails offering tickets, by the way.
Look, they're listening to your first comment, not necessarily the look in your eyes. Please don't just ignore what I'm saying. Yeah, exactly.
Brazil. Something like that. I don't know.
Now you're getting choosy.
No, should I pick a date?
Yeah, exactly.
Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg, the Trump administration is moving closer to Democrats' demands over Homeland Security funding. Meanwhile, U.S. Border Czar Tom Homan holding a press conference in Minneapolis this morning. He arrived 2 days ago and is leading ICE operations in the city. Meanwhile, President Donald Trump taking to Truth Social this morning to continue his criticism of Federal Reserve Chair Jay Powell. The president, writing, Jerome "Too Late" Powell again refused to cut interest rates, even though he has absolutely no reason to keep them so high. President Trump adding, we should be paying the lowest interest rates of any country in the world. And it's the end of an era at Southwest Airlines. The company is ending its decades-old practice of open seating. Assigned seating is being rolled out this week. Southwest says seating changes are meant to keep up with evolving customer expectations, plus boost profits. The Dallas-based carrier is also charging travelers for checked bags now. That's your Bloomberg Brief. John?
Yahara, thank you. The good old days on Ryanair. It was wild.
Okay,
used to line up really early. Used to line up really early.
Choose your own adventure.
You'd line up so early.
It was crazy.
Like 2 hours before it takes off.
The good old days?
And then the sprint across the runway to get on the plane and block seats for the rest of the family.
Hold on a second. The good old days? Would you ever do that again now?
No.
Okay.
No, absolutely not.
No,
No.
but you just
It is fun at first. It is fun at first to experience it.
Yeah, exactly. Of
That's
course.
just what it was.
Right, but it's good old days.
£15 to fly to Italy back in the day.
So I can't tell. Is this romancing it, or is this sort of discussing the things that you leave behind?
Bit of family fun, Bramo, sort of like fighting everyone off to block the seats.
When Junior is of age, you can take him just to experience that.
Sure, he'll love that.
I'm sure he will. It's like, listen to what Dad has
June
to do.
13th, by the way. MetLife Stadium. Anyway, up next, the Morning Calls Plus. Ed Ludlow joins us as big tech earnings continue. Apple set to report after the closing bell. Live from New York City this morning. Good morning.
Over the next 3 to 5 years, when you start thinking about the shift toward an AI world, it is going to be dictated more on the physical AI opportunities. We've kind of seen this accelerated shift away from SaaS to kind of the more chip making related names here.
Big divergence opening up in tech at the moment over the last several weeks, few months for that matter, between hardware and software. That was Angelo Zeno of CFRA. Your equity market doing okay, and I stress just about okay, up by 0.1% on the S&P, unchanged on the Nasdaq 100. That's the price action. The opening bell at 1 hour and 11 minutes away. Here are your morning calls. First up, Morgan Stanley removing Microsoft as a top pick following earnings, noting disappointing growth in its cloud computing platform. That stock is down almost 7%. Your second call from KeyBank raising its price target on Meta to $8.55, believing its fourth quarter results are a blue sky scenario. That stock is flying. It's up 9%. And finally, Mizuho upping its price target on Tesla to $5.40, seeing the company is well positioned as a leader in physical AI. The stock is up by 1.8%. Let's stick with tech. Apple next up to report as mega cap earnings are doubling down on AI. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the program, sir. A big divergence in the price action between Meta and Microsoft. You covered the numbers as they dropped. What stood out for you?
It's the same equation, though. You know, the concern with Microsoft from the sell side and the buy side is very simple. Capital expenditures accelerating and growing beyond the pace at which revenues are growing. And actually, you know, Azure, the cloud unit, is the key metric by which we judge Microsoft's AI success, seeing decelerating growth. And, you know, with Meta, even though the capital expenditures forecast for this year up to $135 billion is kind of eye-watering, right? They give Meta the benefit of the doubt because Meta, differently to Microsoft, showed outperformance in revenue growth and was able to evidence through various different data points, actually, that it is directly tied to their existing investments in AI.
They're all taking these big bets. And Ed, I think that's what these companies have in common. Meta, Microsoft, Tesla, they're taking massive bets. And then you've got Apple. Yeah. And Apple is a curious one because they don't fit in to that. It doesn't feel like they're taking major bets right now.
The only sort of analogous thing is probably Tesla to Apple, because as hardware players, they're facing very difficult environments. And we talked about it less on the blog in the context of Tesla, but it's a very difficult environment. Apple's probably going to have its best ever quarter. The data from the prior quarter showed that China was improving. The soft third-party data shows things are quite good. But not to overstate this, John, the situation with memory chip prices is very severe. And so Apple, which we've in years past called the master of bottom line management, is going to have to face very difficult decisions to pass on that cost to the consumer in their handsets or not. You know, it's really tough out there, like well beyond tariffs. We're back to having some supply chain issues. And I was listening to a last guest talk about kind of like throwbacks to the COVID era. A lot of what we see in the commentary of all of these companies is very representative of what we were seeing in 2020, 2021. So that's kind of interesting.
Ed, I have to say, I don't really feel terrible for Apple when you say it's hard out there. And I see the line out the door to spend $2,000 on products.
Quite.
So there is definitely that sense. Although I will say they are the biggest underperformer among the Magnificent Seven cohort since late last year. A real question here about whether there's sort of a bifurcation now from some of the buyers of some of these memory chips and other expensive components and the providers, right? I mean, we see this sort of shaking out in terms of profitability. Is there some kind of divergence that's identifiable, or is it case by case?
Case by case. I mean, I was surprised that Elon Musk gave such specific commentary last night about the memory chip market. And, you know, he basically put it pretty simply. What's happening in memory chips is more severe than what is happening in AI chips. The issue as well, it depends on who you are. If you are Apple and particularly if you're NVIDIA, but we're talking about Apple tonight, right? You have a lot of leverage with your suppliers. And if your suppliers are tight on supply, and supply, obviously, tight supply drives pricing, you have a better ability to negotiate. So, Apple's management of that will be looked at. But you're absolutely right, by the way, big picture, like Apple does look good right now on the hardware side. Inevitably, people will still say, when is the AI-powered Siri coming, and give us some real evidence that you actually are a player in this AI thing. But beyond that, hardware company, and John's completely right, we're heading in slightly different directions now in the software corner of this market and the hardware corner of this market.
Ed, can we say anything about what kind of spending on CapEx is rewarded in markets and what isn't? I mean, it's sort of the Microsoft Meta breakdown in this question of whether Apple will get rewarded for investing in AI or not to try to keep up with some of its competitors. I mean, what makes certain CapEx good and what makes it bad?
Covering Mag 7 technology earnings is very difficult. Because they don't have a common metric. BI does a really good job of tracking longer term CapEx projections, but they report this in different ways. So Microsoft's story was that CapEx was higher in the quarter gone, and they give some incremental commentary of going forward. Meta just comes out the gate and goes up to $135 billion this year. And historically, as you guys know, Meta gets punished when spending is too high and the loss-making units have a loss that is too wide. But actually, in this context, Meta's $135 billion post, the market was very calm about it. They kind of think, well, that projects quite a lot of confidence. The biggest surprise for me last night is Tesla coming out and saying $20 billion of CapEx, because that's double its historic average, double what the street was expecting. And, you have to take it with a grain of salt, I suppose. But Musk also is talking about Tesla becoming a chip maker. And that's not even factored into their CapEx forecast. But based on the market reaction this morning, investors look at it and go, this is quite useful data, thank you.
Ed, I think Annmarie's got a complaint. Just a brief complaint.
Ed, try covering the Trump administration. I have the smallest violin for you out in San Francisco with the mega tech hyperscalers, please.
I get it. Yeah, but look at the bags under these eyes and this shade, and, it's hard. That's all I'm saying.
It's 5:30 in the morning. I got to give Ed
You're going to get offered a
He's
skincare regime in a minute. Ed, go. Run. Ed, thank you, sir. Appreciate it.
He needs to wear the patches under
what are those things you're wearing?
Yeah, I'm going to send them. I'm going to send some. Don't worry, Ed. They're coming your way.
Okay, all right. Coming up on the programme, the latest jobless claims data set to cross. We'll catch up with Nancy Lazar of Piper Sandler with us to break down the data and look back on a news conference with Chairman Powell. Chairman Powell at the end of that news conference feels a little looser. He's ready to go.
He's ready to go.
It's like you ask him a question, no thanks, I want to talk about this instead.
Yeah.
I don't have to entertain this anymore.
And he said that a million times. Actually, he said it 7 times. I don't have anything for you on that today. And then he said something like, I'm not going to comment further than that statement, so check it out.
He's got 2 more meetings circled on the calendar.
Not going to work on the Hill.
Then he's got a cruise.
It's not going to work on the Hill.
He's got a cruise.
I got nothing for you, Senator.
He's got $1 million speech, and then on a cruise again.
Yeah, you could have sent him on cruises.
It's not a bad lifestyle, is it?
It all depends on what kind of cruise it is.
True. River cruise. Disney cruise, no. River cruise, yes.
I have ideas.
"60 minutes away from the open, about seconds away from the economic data. The scores look like this. Equity futures on the S&P up by 0.2%. The Nasdaq 100 up by almost 0.1%. In the bond market, it has been sleepy, that's for sure, over the past few months. We are near the upper end of the range for the year so far. 425 on 10s this morning, and 2 still anchored around Fed funds at 356.93. With that economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. The numbers are just coming out now, and we don't see much change in the numbers for initial jobless claims. They do rise to 209,000 last week, but that's still a very, very low number. Now, we should point out, you've heard a lot about layoffs the last 48 hours or so, including more today from Dow. Those won't show up as jobless claims until those people's severance runs out. So we wouldn't expect the numbers that we've heard this week to suddenly show up. But all right, here's the interesting thing. Last week's numbers were revised up from 200 to 210. So the rise to 209 is actually a decline to 209. So that's the way these things work. A couple other numbers that are out this morning. We have the non-farm productivity and unit labor costs revisions, and there's no revision, 4.9% for productivity in the third quarter and negative 1.9% for unit labor costs. But here's a number that will matter to the economy, and that is the trade balance for November. Remember, it came in at $29.2 billion, an extraordinarily low number when first reported, it reported for October. The number is for November 56.8. One of the reasons that the Atlanta Fed GDP Now number is so strong is because imports collapsed in October after so much stuff was pulled forward. And now it looks like we're getting much more of the kind of trade balance we have been getting in the past. Imports rose 5%, while exports fell 3.6%. So that will add, it will subtract basically from that GDP Now figure, and probably we're going to fall under the 5% anticipated number at this point.
So, Mike, you think, and you're indicating really, and I think this is important, that the trade numbers have kind of been skewing the GDP read that we've been getting. Can you tell us about underlying demand? What's happening just to broader consumption outside of that story?
Well, underlying demand has been relatively strong. It has slowed some, and there's going to be a lot of interest in fourth quarter spending. Retail sales have been okay and personal spending okay, but we don't have that data for December out yet. So we're waiting on that, and that will tell us much more about how strong the economy is. One thing that's going to be concerning is this collapse in consumer sentiment, because people spend what they earn, and the consumer confidence numbers that came out from the Conference Board this week suggest that people don't think jobs are going to be available, and they don't think their incomes are going to be going up in the months ahead. So in that case, they may be a little more cautious in spending.
Mike McKee, appreciate it. Thank you, sir. Joining us now to continue the conversation, Nancy Lazar, Piper Sandler. Nancy, good morning. Good to see you.
Good morning. Nice to see you.
Mike McKee indicated there the X minus M part of the GDP formula is kind of skewing things at the moment. Would you go with that?
Oh, absolutely. I mean, Atlanta Fed had 5% GDP for the fourth quarter. That's probably now unlikely, but something close to 3 to 4% for the fourth quarter is probably still likely.
Do you have a better sense of exactly what these jobless claims mean at a time when they seem to be flat, despite what we heard from Mike just there? We're hearing these job cuts announcements. There is this churn under the surface, and there's a lot of low sentiment. So how do you gauge these numbers and what they mean?
Well, actually, I'm quite excited the fact that claims haven't increased in the face of these layoff announcements. I think it's in part because small businesses are starting to rehire, and 80% of jobs in this country are created by companies that hire less than 500 employees. And certainly that's not the companies that have announced these layoffs today. So small businesses, medium-sized businesses are highly cyclical, and they're now feeling the lagged effects of the Fed easing cycle. I mean, Fed is probably done cutting rates, but they've already cut rates 175 basis points. And it takes roughly 2 years for that to actually impact the economy. So that's 24, 25. So right now we're in the sweet spot where lower rates are helping to support small businesses. And so the NFIB data is looking encouraging. And so we're ending the bifurcation, I think, in the labor markets, where you, out of the pandemic, it was the big companies that were hiring. Now maybe they overhired, and now you're starting to see smaller companies hire. And again, they drive the job market.
Forgive my strange faces as I try to contort myself to try to understand what this economy is doing, because I'm really struggling here.
Yeah.
If you could characterize things, is this late cycle, early cycle, mid cycle, given the fact that the growth figures are kind of skewed with GDP that are being influenced by trade, the jobs numbers are being skewed by some of the different industries? I mean, how would you characterize the cycle?
I'd have to characterize we're mid cycle. It reminds me of 1995. In that you had a Fed easing cycle in 1995, maybe even 1996. The Fed tightened aggressively in 94. You obviously had it was a tech-led boom in the economy in the early 1990s. Then the Fed realized they were behind the curve, and they raised rates in 94 very aggressively. Sounds familiar, 2001, 2002. And then they cut rates, 75 basis points in 95 as the economy slowed. And then the economy took off again in 96, and they stopped cutting rates. So it reminds me of mid-cycle of the 1990s.
If they stopped cutting rates, and you're talking about this productivity boom, is the Fed done for this year?
I think they should be done for this year. Productivity gives you stronger potential GDP growth. In the 90s, it only took a 75 basis point cut in Fed funds at a certainly higher level than we are today, to reaccelerate growth from 2 to 4%. That is because when you have a stronger productivity, think of a healthy company. You don't need significantly lower rates to get growth to reaccelerate again. And I think that's where we are today.
Well, the president certainly wasn't happy with the decision yesterday. He made that known today in a Truth Social post. How difficult, if you don't see any rate cuts needed for this year, is it going to be for the new chairman?
I think the messages can change. And I think there's a chance as we go through the year, it's like you look over your shoulder and it's like, son of a gun, the unemployment rate has stopped going up. Maybe it starts to come down. You start to see healthier job growth in 2Q. GDP growth is at least 3, maybe even 4. And the administration could come out and say, I guess we've done our job. The economy is actually now improving. They do change.
Does that help housing?
Pardon me?
Does that help housing? Because that seems to be a sensitive issue.
So I think it does. The last thing we need from housing is another major easing cycle. That obviously created the boom in housing in 2005, 2006. And even in 2009, 10, 11, you had another pickup in house prices, and you ended the decade with another, I would argue, housing bubble in 2017, 18, 19. And we saw that during COVID. Slow, moderate improvement in housing is actually healthier for house prices. You don't get another boom, and you make it longer term affordable. You are already seeing that down south, where you have put in place a lot of new inventory. You're already seeing that in new house sales. New house sales have picked up because new house prices have come down because they overbuilt. So we are seeing an incremental healing in the housing market. Housing is becoming more affordable. Just don't try to buy something here in the Northeast or the West Coast. You got to move down south.
This is an interesting point, though, that you're making, that lower rates could be problematic, could have unintended consequences.
I totally believe that. You go back and look at history, be it the late 60s, be it what happened to us in 2005, 6, what happened after the GFC. Totally, I think you can create economic excesses. You get a boom and then you get a bust.
So does that mean that you think that dropping rates lower from here substantially, unless there is a material shift in the economy, could lead to a harmful or some sort of bubble type behavior in risk assets?
I really do. I mean, nominal GDP in the third quarter, quarter to quarter, was over 8%. In the fourth quarter, probably it will be at least 5-6%. And then you have Fed funds roughly of 3.5%. That's a huge gap. If you think of the economy as a company, again, revenues are growing at a very healthy pace, and if you lower rates too aggressively, you do risk creating another bubble, be it in tech. That's what happened in '98 after Greenspan lowered rates sharply in just a couple of months after the Russia LTCM crisis. That really created that last boom in the tech bubble, and then he had to raise rates, and that created the bust. So yeah, I think a more moderate level of interest rates when we have such healthy growth trajectories, albeit housing's not booming, but that's fine. Yeah, I think it sustains a cycle.
If I were channeling Fed Governor Chris Waller, I would say, okay, this sounds really lovely, but you look at the sentiment surveys, you can see consumer sentiment is really negative right now. You look at some of the job loss announcements, Dow, for example, coming out and saying that they're going to cut 4,500 jobs this morning, saying that they're going to use artificial intelligence to bridge some of those gaps. This is a market that calls for lower rates to try to support the employment level. Why would you push back against that as saying that's not valid?
Okay, so first on consumer confidence, I would argue there are 3 measures of consumer confidence. You have MISH, Conference Board, and then we have our own measure of consumer confidence. Those other 2 have been totally wrong when it comes to consumer spending. Consumer spending was 3.5% in the third quarter. It's going to be at least 3% in the fourth quarter, whereas those numbers suggest consumer spending should clearly be deteriorating. It's not. Maybe it's more a political statement than is an economic statement. Our daily consumer confidence survey actually turned up after the government shut down and is consistent with a healthier consumer. So one, you have to look at all the data, which we try to do. And so first on consumer confidence. On AI, technological innovation is what creates new jobs. In the old days, if you go back to the 70s or talk to Greenspan, he used to seasonally adjust data by hand. Economists at some of the big banks in the 70s would plot graphs by hand. Well, those entry-level jobs disappeared in the 1980s, thank God, because that's when I started. And you use computers. So creative destruction is actually what makes the economy, the U.S. Economy, exceptional. I still think we are exceptional.
You're very constructive on the economy going forward, but it is an election year. I know everyone's talking about tax refunds, but also this president is willing to run it hot and is going to push Congress maybe to do other fiscal stimulus. What do you think that is going to mean for the inflation picture?
So my colleagues in Washington who are experts on this, and I am not, suggest it's going to be very difficult given the makeup of Congress today to get additional fiscal stimulus. And it's not just the tax refunds. That is kind of like a sugar high for the economy, and that starts next week. We're very, very focused also on other more structural things that they've done through full capex depreciation and also deregulation. So those things we think carry the economy as we go through the back half of the year. A lot of the street thinks this is a sugar high, strong growth in the first half, weak growth in the second half, and we disagree with that. We don't need more fiscal. I'm actually quite impressed with the productivity that's coming out of Washington. My heart does go out for those who have lost jobs in D.C., but at the end of the day, maybe it was a little bloated. And you're improving productivity. Federal outlays have actually stagnated, which I think is good news. And so I think the fear of the deficits is also a little bit overstated.
Punchy segment, thoughtful stuff. This was good. It's good to see you.
Thank you very much.
Thank you. Nancy Lazar there of Piper Sandler, echoing a stronger outlook that I think was presented also by David Levitz only about 40 minutes ago.
Yeah, pushing back against the consensus, although everyone on the show, the consensus has been that it's been a strong first half and a strong second half, and then ultimately the productivity gains really will be something that is sustainable. I think that the headline is really Ed Yardeni. Productivity is the fairy dust, and that seems to be what a lot of people are banking on.
Right, and he says he's been talking about the roaring 20s now for years. But for Nancy's point at the end there, it's almost like she can go in and run Doge. That effort has sort of fell by the wayside, but a lot of people on Wall Street were excited about it and moving from public sector jobs into the private sector.
I'll just say it's nuts how quickly this decade's going. Because I remember that note that came from Ed Yardeni back in 2020. It was like the roaring 20s, and here we are 6 years into the thing.
Yeah, no, I agree.
Crazy.
I mean, it is crazy. I'm also still thinking about what jobs I can outsource. I'm trying it with ChatGPT to see what I can get rid of. It's tough. It's not good enough yet.
What are you trying to outsource?
Well, it's just questions about please compile all job cuts that have to do with this, not very good. Please compile research, to try to make it easier for me so I don't have to do it, but it doesn't work.
If you figure it out, let me know.
Okay, thanks.
All right. Equity futures on the S&P, positive by about 0.25% with an update on stories worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Recapping that data we just got, initial jobless claims for last week coming in at 209,000, just a tick above estimates, and below the figures for the week prior. It was a holiday-shortened week marked by severe winter storms across much of the country, which of course can impact the data. Meanwhile, continuing claims fell to 1.83 million. Jersey Mike's Subs, a sandwich chain with more than 3,000 locations, is reportedly working with Morgan Stanley, JP Morgan, and Jefferies on a potential IPO. Sources telling us here at Bloomberg the company is seeking a valuation of at least $12 billion, and more banks are expected to be part of the lineup. And talks to avert a government shutdown gaining momentum ahead of today's vote in the Senate. Sources telling us here at Bloomberg the Trump administration is moving closer to Democrats' demands over Homeland Security funding. U.S. Border Czar Tom Homan holding a press conference in Minneapolis saying he aims to cut the number of federal officials in the state. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next, Earl Davis of BMO saying the Fed's easing window is closing fast. Plus, Yahara has your morning movers. Whirlpool shares plunging after its outlook disappoints. That stock is down by about 10%.
If trend growth is coming down and we are in a pre-financial crisis world, then so too is R-star, or the real equilibrium interest rate. And as that comes down, the Fed can continue to lower interest rates. In fact, they would have to continue to lower interest rates just to maintain the current level of accommodation in monetary policy. So there is definitely scope for them to keep cutting rates.
That was Matt Hornback of Morgan Stanley. Equities at the moment positive by about 0.25% in the stock market, pushing just a little bit higher, up by 0.2% on the Nasdaq 100. With some morning movers joining us now for more. Here's Yahara. Hey, Yahara.
Hi, John. We start with the appliance maker Whirlpool. Shares are plunging down 10% in the pre-market, and it all comes back to tariffs. Hear this, what CEO Mark Bitzer said. He said, even though as a company, obviously, we like the concept of tariffs, it did not help us in 2025. That's because Whirlpool says that competitors front-loaded inventory, keeping their prices low. So Whirlpool was not able to capitalize as a domestic manufacturer. So that caused sales to miss in the last quarter, and the outlook not so good either. Meanwhile, shares of U.S. rare earth companies are falling in the pre-market after a Reuters report said the Trump administration is stepping back from plans to guarantee minimum prices for critical minerals projects. That's a reversal from last year when floor prices were promised, according to Reuters. And remember, the U.S. government did take stakes in USA Rare Earth and MP Materials. And we end on the divergence we're seeing in the tech trade, a big story today. We are seeing Meta shares now up nearly 10% in the pre-market as it gets a pass to spend big on AI, up to $135 billion worth, because the payoff is showing up, especially when it comes to ad targeting, which of course is the engine of its business. Microsoft not getting to the same path. Shares are down 6.5% in the pre-market as investors scrutinize its record capex. John?
Big divergence there. Yahara, thank you. Great work this morning. Brilliant, as always. And it's pretty easy to explain the story. If you're going to spend a lot of money, make sure it shows up in revenue. And that's the story, the divergence between those two names.
Yeah, if you're going to spend money, also prove that you're not doing it to play catch up. Prove that you're doing it to get ahead of something. And that, I think, also is the key. It's also a question of, all right, Meta already went through their efficiencies, et cetera. They're actually showing that they're able to do the advertising. And Microsoft, I don't know, it's still kind of at the wrong end of the trend right now.
Apple up next after the closing bout, the next big tech player to report earnings after the close. Your trading diary is shaping up as follows. We'll hear from the president later. He speaks at 11 a.m. Eastern time. After the closing bout, we'll get those earnings from Apple. Tomorrow, the government funding deadline plus results from Chevron and Exxon, followed by PPI data and the return of Fed speak. Earl Davis of BMO's got a lot to say on the Federal Reserve. This is what he has to say on this committee. The US will be on hold for the foreseeable future. The window for one more ease is closing fast. Earl joins us now for more. Earl, welcome to the show. Is that the window for Chair Powell's Federal Reserve or just the Federal Reserve for the year ahead?
Being Chair Powell's Federal Reserve and the year ahead, actually. So let me back up. So with your previous guest, the fiscal stimulus in the market, I largely agree with that. It's largely discounted, so move on, carry on. There's no further impacts of that. Further eases, monetary eases, two eases, largely discounted in the market. There's no further impact for that. What's not being discounted in the market, and that gives me extreme concern, is the broadening of the commodity rally. Fed Chair Powell was asked us about gold and silver, and he said we include in our macro, but it doesn't have any impact necessarily on monetary policy. I agree with that. Having said that, when that commodity rally expands into what we're seeing today, copper almost up 10% today, that has significant impact into the AI build-out. There's a significant amount of copper used for the energy in those build-outs. That's a significant increase in prices there. And that's not even to speak out the build-out for energy that's required in North America in general. I'll also add in gas. At $65 now, when you look at oil at $65, has direct implications on gas, which is a consumer tax. So and now you're seeing in wheat and a broadening, and we expect this to continue. And the reason why we expect it to continue is silver and gold are stores of wealth. Wealth is future spending. When you look at wheat price, oil price, copper price from a gold and silver perspective, it looks very cheap. So we could see continued buying there when you look at it on that matters. And that's what's concerning from an inflationary impact that the market is, I would say, complacent about right now. And my team's actually having a meeting in an hour to say we're overweight credit, to say whether we should reduce that overweight or not, and go underweight duration in 30 years for because of the broadening of the commodity rally.
Earl, that's exactly where I wanted to go with this question of what assets get hit hardest if people are underestimating the commodity-driven inflation that could be in the system.
Yeah, I apologize for the sun changing. I had the perfect cloud before. So what's interesting is we are constructive and positive on the market because of everything that's been mentioned, the fiscal, the monetary, the tax rebates. We feel the U.S. growth story is going to maintain and be sustainable for 2026. What this commodity and the widening of this basket does, it's going to add a significant amount of volatility to the market. That's what that's what's not being anticipated. And I think what you get is a rotation to real assets, basically, to answer your question. Rotate out of financial assets to real assets. But that's going to take a longer term story. It has some legs on it. We're still buyers of risk, but we're reducing our risk now to buy at better levels, which we think will have, given how tight valuations are right now.
Is your take on duration a U.S. phenomenon, or is it a global phenomenon that duration around the globe could suffer in the face of some of the commodity boom?
That's a great question. And I would say the further out the curve you go, the more global a phenomenon it means. So 30-year bonds. So when I say we're looking at going underweight duration, it's not 2-year bonds, 5-year bonds, or even 10-year bonds. It's 30 years we're looking at going underweight for two reasons. One is that's the one that has the most influence globally. We're seeing what's going on in Japan. You could get some fiscal expansion, continued fiscal expansion in Europe as well, too. So that has impact in regards to if I'm going to invest in 30-year bonds, I can invest somewhere with a higher yield once swap back to U.S. So that's one thing. It's globally. The other thing, too, is there's just so much price risk when you have a 30-year bond that we feel we're not being rewarded for it now with these levels. 10-year bonds, we feel comfortable going long or buying 10-year bonds as we approach 450 and go higher. The one thing to remember why we feel comfortable buying bonds on backup, if we do, for some reason, break the high yields of last year, which is our premise, like the yield for 2025, the spread of that yield or the range will be the same range in 2026. And we feel very confident about that and buying at the higher end of the yield because that's when the talk about QE comes back into effect. It'll snap back in bonds, add to the volatility. That's why we love being active managers in this environment. It's perfect.
Earl, I've got a buy recommendation for you, some shades. Earl Davis, thank you. BMO.
Yeah, I know.
Asset Management.
I'll take the sun. It just came out at the wrong time here.
Thank you, buddy. Appreciate it. We'll let you go. Let's get to this move in copper. Moves we have not seen in 17, 18 years for this metal. Copper up by 9 to 10% in today's session. Monster moves.
Yeah, and this is being fueled by China in particular, kind of hoarding it. It just raises this question, how far can some of these moves go, given the fact that we're seeing penny-like stock moves in the likes of copper, in gold, in silver.
Copper, Caterpillar,
exactly.
the Aussie. It's just
the real world.
Amazing. John Stoffels of Oppenheimer joins us tomorrow. Neil Dutter of Renmac, Alex Altman of Barclays, Michelle Weaver of Morgan Stanley from New York City this morning. Good morning. This was Bloomberg Surveillance.
The semi-finals are set at the Australian Open. Jessica Pegula reached the Final Four for the first time in Melbourne after she took out fellow American Amanda Anisimova. The New Yorker will face Alina Rybakina for a spot in the final. On the men's side, Jannik Sinner dispatched Ben Shelton to reach the Final Four for the 9th time at the Slams. Novak Djokovic awaits in the semis.